about Donald Trump, who, Rick, I would remind our listeners and viewers, is only 3 years younger than Joe Biden. If we're considering how the Republican about to become nominee in Milwaukee next week is viewing all of this, does he need Joe Biden to stay in this race?
Kayla, you make a really key point. I mean, because the focus is all on President Biden, we've forgotten the disastrous candidacy of Donald Trump. Yes, over half the population believes that he's too old to be president of the United States and are hesitant to vote for him for that reason. 2, he's a convicted felon 34 times over. 3, he says the most outrageous, non-American things you could ever say from the platform of his stages of the events that he runs on. I mean, like, let's just go through the disastrous Trump campaign, because if we were focused on him, it would be a completely different conversation. The problem is there's only so much bandwidth in anxiety that the American public or the media can handle at one time. And Joe Biden has bought the entire bandwidth. I mean, he's really owning the airwaves in the most unlikely and unfortunate way. But this is the reason in that poll that you still have them tied. Both of them are a disaster by American public point of view, and they yearn for an option, and in both cases. And so, yeah, at least there's a debate about whether or not that's going to happen on the Democratic side. Republicans would be much better off with a more neutral candidate running for president. We would beat Biden hands down in that kind of a contest. But we've put up the one person that Biden, even in his weakened condition, could actually be competitive with. And that's very much part of the story that's not being told.
All right, Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, always helping us to tell the story. They'll be back with us later on this evening as we bring you special coverage of President Biden's news conference and, of course, Balance of Power, the late edition.
Fitz Muslim says we want to see more improvement in supply conditions.
In our 99.1 newsroom here in Washington with Nancy Lyons. Hey, Nancy.
Thanks, Kaylee. President Biden will need a strong performance in his solo news conference scheduled for later today. The steady drumbeat of concern continues over his ability to serve if elected in November. Aides from the White House and his campaign have been meeting with Democratic senators today ahead of the news conference, hoping to allay their fears. Gun control advocates are raising the alarm after a Texas-based company called American Rounds started installing vending machines that sell ammunition in grocery stores. This is in Alabama, Oklahoma, and Texas. The company says the machines use an identification scanner and facial recognition software to verify age. Grant Majors is the company's CEO.
We feel like we have the safest and most secure, method of ammunition sales in the country. I've personally walked into stores and big box stores and found open boxes of ammunition just sitting there on the shelf.
Major says he has a waiting list of some 200 grocery stores that want to install the machines. Michael Bloomberg, the founder and majority owner of Bloomberg LP, is a donor to groups that support gun control, including Everytown for Gun Safety. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
The idea that parties vote the same despite representing districts or states that are all across the country, that's just insane. And so if I could wave the magic wand, I'd get rid of the two parties.
We ended up having kind of a friendly conversation.
With a gun pointed at you?
Washington, D.C. has become a punchline to a never-ending joke.
How come that clock doesn't work?
No, it does. I think the term we use is it's wicked old.
How you been?
What does it mean for you to have someone who can know your community?
These aren't all paid actors, I assume.
How you doing? Take a selfie? Only if you want one. We all wear masks every day. Sometimes if you keep that mask on, you forget who you are and you take on the characteristics of the mask.
We're kind of like a big family, and sometimes the family's not always entirely functional.
Have you considered calling any of their mothers or something to reparent them?
There's an idea. I kind of like that.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's 1:40 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow holding on to a 16-point gain right now. Little changed, up less than 0.1%. Stocks are seeing a big rotation with the S&P now down by almost 1%, down 51 points, back below 5,600, 55.81 on the S&P. NASDAQ hard hit today, down 347 points, a drop right now of 1.9%. But the Russell 2000 index of small cap shares heading in the other direction, small caps up by 3.4%. That index on track for its best day for 2024. 10-year 4.19% with a 2-year that's yielding 4.50%. Gold up $42 the ounce, 24.13 up 1.8%. While West Texas Intermediate crude 82.46 a barrel. WTI right now up by about 0.4%. So again, we have got stocks trading trading mixed. The Dow trading higher, up by about 0.1%. S&P down 0.9. We've got NASDAQ right now down by about 1.9%. Pfizer is moving forward with a weight loss pill as the drug maker seeks to crack the multi-billion-dollar market for obesity medications and mount a comeback from its post-pandemic malaise. Pfizer says the once-daily treatment will progress to a mid-stage study in the second half of the year. Right now, we have got Pfizer shares trading higher by 1%. Among some of the companies out with earnings today, Delta Airlines, the stock being hard hit. Right now, we've got Delta down 5.5%. It says it expects profit this quarter to fall short of Wall Street expectations. Other airlines moving lower as well. Case in point, United down 4.2%. American Airlines lower now by 4.4%. Southwest down 2.8%. JetBlue, meanwhile, up 0.2%. So again, recapping, highly divergent market right now with the Dow up 0.1%. Russell 2000 up 3.4%, but the S&P down 0.9. Again, the 10-year 4.19%. Balance of power continues now. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you. Welcome to the fastest show in politics, the Thursday edition, as we count down to Joe Biden's news conference. We're about 5 hours away at this point. At the conclusion of the NATO summit here in Washington, the commander-in-chief will hold forth. Some are framing this as the test of his political career. We spent the better half of this hour talking about that, but we want to look more at some of the policies that he's dealing with in town. Kaylee, the biggest, of course, Ukraine. It's the backdrop to this entire summit, with confusion in Europe following elections there and confusion about our own here. But Prime Minister Starmer talking today about allowing Ukraine to use UK-provided weapons in Russia, and that's a big part of the conversation in a bilateral meeting that's getting underway right now with Joe Biden.
Yeah, in fact, we've gotten some quotes out of that meeting. Joe Biden meeting with President of Ukraine, Volodymyr Zelensky, in part complimenting him for some of the successes Ukraine has seen in stopping Russia. One of the quotes from President Biden to President Zelensky: "You've imposed significant costs on Russia and made it clear Russia will not prevail in Ukraine." But of course, significant costs have also been inflicted on Ukraine in the years of this conflict. And that is where we want to have a wider conversation now. I'm pleased to say joining us here in our Washington, D.C. studio while she is in town for the NATO summit this week is Olga Rudneva. She is CEO of the Superhuman Center in Ukraine. Superhuman Center is a clinic for psychological assistance, prosthetics, reconstructive surgery, and rehabilitation for people affected by the war. Olga, welcome to Bloomberg. Thank you so much for joining us. I do want to get into the conversations you've had here during your time in Washington, what you are hearing, but I feel like first we should ask what you're really seeing on the ground in Ukraine. What do we need to know about conditions?
First of all, thank you very much for having me, and thank you for all support Ukraine have from the American people. You know, we definitely proved the world that we can win this war, but we can't win this war without external support. You know, being 2 years into the war, we are quite exhausted as a country with our resources going, down. So we definitely need external support, and America is playing a huge part in our victory. So what is happening in Ukraine? We have electricity for 4 hours per day. We can't use our air conditioning. We are in blackouts constantly because most of our, infrastructure is ruined. On Monday, we had a huge attack on a kids' hospital and on maternity house. So a lot of doctors killed, and it's a civilian infrastructure. Every night we go to bed and we don't know whether we're gonna wake up, and it's like 2-3 air Sirens, drones and rockets flying over my country. We don't have enough air defense, and we have a lot of people who are injured, civilians and military personnel in the healthcare system. All our civilian hospitals, they work as military hospitals. And we still have people who are injured at the first day of the war, and new people are coming on a daily basis. So it's a huge and big war, and we are still standing against the enemy.
Well, Olga, you're doing God's work at the Superhuman Center, and you deserve thanks for everything that you're doing, and we want to make that clear. As you join us here in Washington, what is the most common injury that you see?
Well, we have a lot of amputations. 50,000 people in Ukraine lost their limbs, and it's double, triple amputations. And it's caused by the fact that Russians are targeting our medics first. They want to kill as many medicals as possible so they can't save lives. They don't let us to pick up injured people, so they continue shelling. So our injured people are staying at the battlefield for 2-3 hours.
Fed's Muslim says the economy may be shifting into higher interest rates regime compared to pre-pandemic.
So if you put a tourniquet high, by the time you arrive at the hospital, we cut person high.
Oh my God.
So we see a lot of complex injuries, complex amputations. It's double, triple amputations. A lot of people with double amputation of upper limbs. It's minimum mobility. These guys, they go to the toilet with their wives because they can do anything. So it's 50,000 people who lost their limbs. And that's people who are our clients, our superhumans, as we call them. We provide them with psychological support, prosthetics, rehabilitation, and reintegration. It's very important to give a new reason to this person, a new role in life, because they can't do what they've done before they went to the military. It's very important to help them open their business or start a new life. And recently we opened reconstructive surgery department. We basically return people that are lost faces. It's people with disfigured faces, and it's not only about aesthetics, it's about losing the function, like function of breathing, swallowing, eating, or speaking. So these surgeries are very long. They last for 15 hours and take 2-3 years to restore function and aesthetic of this person. So healthcare system of Ukraine really needs a lot of resources and support while our hospitals being shelled and destroyed by Russians.
Well, so to get into that, we have so much conversation here in Washington that to some extent feels almost removed from humanity. The fact that this is a war that is affecting real people, it focuses on battles over money and weapons. But when it comes to the resources you actually need to be able to take care of these people, whether it's physically or mentally, especially given the apparent willingness of Russia to attack that infrastructure, do you have what you need, or is that something that the U.S. and other NATO allies could provide more robustly?
We definitely don't have enough resources. And when I'm talking resources, I'm talking about human resources. We are inviting doctors from all over the world, prosthetists for upper limbs, to come over in Ukraine and work in multinational teams to help us, great surgeons. So it's a human resources. We don't have enough people working in Ukraine providing medical assistance. Number two, we do need additional resources to provide people with prostheses. And we need to provide people with prostheses as soon as possible, because the longer people stay in wheelchairs, the less chances they'll be walking or having an active life. So we also need additional resources to train physiotherapists because we're going to have army of people who will need rehabilitation services. Right now, it's 1.8 million people in the front lines. By the end of the war, the estimation is up to 4 million. All of these people will need rehabilitation services because they were sleeping in the trenches, they were carrying 30 kilograms plus, malnutrition and other things. So it's a huge need for Ukraine to provide help. And I'm not only talking about military personnel. Our youngest patient is 11 years old. He lost his leg in Kharkiv. And our old patient is 78. She lost her leg during the shelling in Bakhmut. So it's all kind of people, civilians who just lived their normal life at their houses, had dreams, had plans, and one day it's all was stopped by the Russian invasion. And they didn't do anything wrong. They just wanted to speak their language, to have their dreams, travel, go to school. That's it. We didn't do anything wrong as a country.
You left the Superhuman Center to be here in Washington, traveled halfway around the world. Has it been productive?
Yeah, we had meeting with congressmen and we were thanking them for support because we want to be able to finish the war without external support, as I mentioned already. The sooner we finish the war, the sooner we can start reconstructing the country. But not too many people know 40% of Ukrainian territory is mined. It's the size of Austria, meaning that if the war stops tomorrow, we will still have people who are losing their limbs or have disfigured faces or have other traumas. So we need to finish this war as soon as possible because every day of this war is taking the best people of Ukraine who volunteered to go and fight for this country. The sooner we finish the war, we start another war with our mental trauma, with our physical trauma, and restoring the country and going back to normal.
Well, I suspect this is going to be the work for the rest of your career, Olga. We're delighted to meet you and appreciate your insights today. Thank you for coming to see us.
Thank you very much for inviting.
She's on her way to Capitol Hill for more meetings with lawmakers. Olga Rudneva, CEO of the Superhuman Center in Ukraine, in a special conversation today on Bloomberg that you won't hear anywhere else. I'm Joe Matthew alongside Kaylee Lyons in Washington, where the president will be holding forth hours from now in a news conference that will bring this NATO summit to a conclusion. Of course, the matter of Ukraine has loomed large at this summit, and I suspect there will be some questions to the president. Certainly in his opening remarks, we'll hear about his meeting today with President Zelensky, underway now at the White House. But for most, they'll be watching his performance with questions about his age and acuity. And for a little more on that, we bring in Saleha Mohsen, the host of the Big Take DC podcast here at Bloomberg. Saleha, what are you going to be watching for tonight? And I ask you that having heard from political analysts, D's and R's, over the course of this program, all of whom said it's already too late.
It's exactly what you just said, Joe. We are looking at Biden's performance, not his words. And that is really revealing that in a huge press conference where he is summarizing and sending a message to the world after he met with 31 close allies while there is a war in Europe ongoing that is, running amok, out of control. People don't care what he has to say, what the substance of his words are. It's all about, can he perform? And you're right. For some people, maybe it's too late.
Well, so there's the question of whether what Biden says ultimately makes a difference to voters, more so perhaps the way he says it. But what can be said to Biden that would make a difference for the president? Do we have an understanding of who ultimately are the voices he's going to listen to? We know closely, of course, his wife, the First Lady, Jill Biden. But as we have questions about the support of, say, Nancy Pelosi or other leaders in Congress, of donors like George Clooney, Saleha, who are the dissenters that ultimately could be the ones to make the largest difference here?
That's been really interesting to watch as this has developed, Kaylee. The inner sanctum, which is very few people, includes congressional Democratic leadership, so Chuck Schumer, Nancy Pelosi, Hakeem Jeffries, because of his position now, and yes, like you said, the First Lady, Jill Biden, and his sister, Valerie Biden, and a cadre of maybe 3 or 5 more close advisors who have been with him for decades or many, many years inside the White House right now, who are really there to listen and support him. And the message, what is going around that inner sanctum, has been tight-knit. What we know is what Nancy Pelosi said, and as a reporter in Washington, I know she speaks very, very carefully, so she did not directly endorse Biden running for a second term. That is really saying something. She went out there to say, hey, he needs to decide, and while we have foreign allies in town, in the Capitol, at the White House, let's keep this problem in the family. She was admonishing and cautioning her Democratic colleagues, don't spill out into the public sphere, wait till the NATO summit is over. So I expect tomorrow and through the weekend, we're going to hear a lot more from those people who did heed Pelosi's words and decided to wait until the NATO summit was over before they spoke out.
Saleha Mohsen, the Big Take DC podcast drops today in the midst of a stormy week in Washington. Saleha, it's great to have you back. And Kaylee, we're going to do this all over again a little bit later on. 5 p.m. Eastern time is the late edition of Balance of Power, but we're going into overtime. It looks like the White House has delayed the president's news conference to 6:30, or rescheduled, I should say. I'm sure there's a lot happening here with 31 world leaders to balance in a bilateral with the president of Ukraine. But look, things tend to run late, and we'll be in for the duration.
Yep, we're in it for the long haul. We will basically be playing straight through from 5 p.m. onwards because this is a critical moment in Joe Biden's presidency and, of course, his re-election campaign. It remains to be seen whether that re-election effort will continue beyond the coming days, Joe. It all depends on how he's able to perform tonight.
We're going to find out together. Meet us back here at 5 o'clock. The news conference at 6:30, only here on Bloomberg, as we prepare for Bloomberg Business Week. It's coming up next. Tim and Carol at the Bloomberg Green Festival in Seattle. We'll see you back here in a few hours on Bloomberg TV and radio.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
A very good morning and afternoon, everyone. We are live in Seattle from the Bloomberg Green Festival. It's day 2 of our coverage here. Welcome to our audiences on Bloomberg TV, Bloomberg Radio, on YouTube, and Bloomberg Originals. Joining us on this Thursday, July 11th, 2024, I'm Tim Stenevec. My co-host, Carol Masser, she's going to be along shortly with her panel live from the event here in Seattle with Sue Bird, WNBA legend, also the co-founder of Together and A Touch More, also with Amazon Chief Sustainability Officer, Kara Hurst. We got a great program coming up. In just a few minutes, we're going to hear all about investing in climate technology with TPG Executive Chairman Jim Coulter. He's going to be joining Bloomberg's Jason Kelly. We're also going to be joined by Ryan Spies, Managing Director of Sustainability over at Alaska Airlines. We're going to talk all about what the airline industry is doing and how much more they need to do when it comes to sustainability. Also, a little later in our program, we're joined by Gina McCarthy, former U.S. EPA administrator and the first White House National Climate Advisor on partnership, leadership, and the right discussions around climate initiatives. Let's get on over to Charlie Pellet for a market update, because, Charlie, we got a little sell-off happening right now.
Indeed. Actually, Tim, it all depends on where you're looking in this market. Yes, absolutely true, looking at a sell-off for the S&P 500 index, but guess what? The Russell 2000 index enjoying its best day of the year. A major rotation underway, that perhaps the afternoon theme for the equity market. Let me begin with the Russell 2000, up now by 3.4%. The Dow holding on to a gain of 0.1%, up 55, but absolutely correct. A sell-off for the S&P 500 index, down 55 now, a drop there of 1%. And also, we are now looking at a drop for the NASDAQ Composite Index, just about the worst level of the day. We got NASDAQ down by almost 400 points, a drop right now of 2.1%. Traders are betting that the Federal Reserve will be able to cut rates soon. That's sending bond yields tumbling while driving a strong stock market rotation. That Russell 2000, worth repeating, up now by 3.4%. Your 10-year, 4.19%. Your 2-year, 4.50%. Gold up 1.8%, 24.14 the ounce. And West Texas Intermediate crude up 0.6%, 82.58 a barrel. Sources tell Bloomberg Tesla is delaying its planned robo-taxi unveiling to October to allow teams to work on the project so they can have more time to build additional vehicle prototypes. Tesla shares hard hit today. We got Tesla, part of that broad tech sell-off. Tesla down now by 7.8%. So again, repeating here, a decidedly mixed U.S. stock market. Yes, lower on the S&P, down 1%, but that Russell 2000 certainly bears repeating, up now by 3.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Tim Stanovic live here at the Bloomberg Green Festival in Seattle. Day 2 of our coverage. In just a minute, we're going to head on over to the main stage where Jason Kelly is standing by with Jim Coulter, TPG founding partner and a managing partner of TPG Rise Climate. They're going to talk investing in climate technology. A little later in our program, we're going to be speaking with the Managing Director of Sustainability over at Alaska Airlines. Right now, though, let's go to the main stage here in Seattle, where we find Bloomberg correspondent Jason Kelly with Jim Coulter of TPG.
On this business, on investing in climate. 1,400 companies. You guys have presence in 50 countries, I believe. I want to have a wide-ranging conversation. I know you have some things to share with us, but I want to start by asking you, like, what's the biggest surprise? This was a massive bet in a lot of ways. Maybe the biggest bet you've made in your career. What have you learned?
I've learned that approaching climate change, you have to think of it as two sides of a coin. For years, since Keeling in the 60s, we've been focused on the need side. We have a problem to solve. But the other side of the coin is actually the opportunity. We're about to undertake a $120 trillion reindustrialization of the world, and that need and that opportunity need to move together. The money can't come from governments. No coalition of NGOs can get it done. Unless we can get the money moving in a capitalist system, we can't solve the problem. So this idea of putting the need and the opportunity together has been more challenging than I expected.
All right, so one of your signature moves as an investor over the past 40 years has been every year you get together with your investors and you put together this presentation. You and I have talked about it in the context of the year ahead. Now, as you're totally focused on climate, you have a version that you've been playing around with and presenting. We have a version that we're going to share with you, and we're going to run through it, if we can bring it up on the screen. All right. So I get to pick and choose here. All right, optimism, green shoots. Let's start there.
Just a little background on this. As well as creating an organization that invests, we actually have a very interesting seat in the middle of the climate ecosystem. We're meeting investors. Literally, I've met with 1,400 entrepreneurs around the world. We're operating $9 billion of climate companies. Those companies are forecasted to replace, against a counterfactual, about 160 million cars off the road for a year. So we're kind of in the mix. But not only are we generating investments, we're hopefully generating insights. So this is us stepping back from that process to watch.
So we're inside your brain right now. This is cool. Let's go.
So first of all, green shoots. And one of the things that I've been a tech investor, I've been a climate investor. Both of them are known for one thing, which is conferences. Like, there are more tech conferences, more climate conferences than I've ever seen, but they look and feel very different. Same hotels, same awful coffee, same bad Danish. But let me show you what a tech conference sounds like. Can we get...
But I'm genuinely optimistic about work in the metaverse. Whether as a hologram sitting next to you in a physical meeting or in a discussion taking place in the metaverse,
I think this technology is inevitable. I think this is the future of the internet. So I think over time you will see greater and greater acceptance.
We believe that AI will be about individual empowerment and agency at a scale that we've never seen before. And that will elevate humanity to a scale that we've never seen before either.
We'll be able to create a theory of the entire universe.
A Tesla car next year will probably be 90%.
That's 2014.
Autopilot. I'm extremely confident of achieving full autonomy and releasing it to the Tesla customer base next year.
Everything is possible. Everything is happening tomorrow, like a font of optimism. Yeah. If you go to a climate conference, it's different, and for good reason. If we can go ahead on this, Bruno. I want to show you a word cloud from a recent climate conference I went to. Supply chain problems, inflation, NIMBYism, et cetera. Essentially, there's almost a paradox of pessimism, and that's well earned. But every once in a while, I find myself saying, I want to just channel my inner tech for a second and like, what could go right? And let me share just a few things that are out there. First of all, I think we have to assume discontinuities. If you look at most of the climate work that's done, it's over 30 years, essentially assuming, and this is, by the way, I'm sorry, if you go back one, please. If you go back to what SBTI just put out for the path to net zero, I want to read this to you, Jason, for a moment. So this is what business is supposed to do. The minimum forward-looking ambition of near-term targets consistent with reaching net zero by 2050 at the latest, assuming a linear absolute reduction, linear intensity reduction, and intensity convergence between the most recent year and not increasing absolute emissions or intensity.
I mean, that makes total sense to me, right?
Now, first of all, there's great science behind that. I admire it. But imagine trying to figure out the iPhone in 1982 based on a computing graph. One thing I know from 40 years in business is nothing is linear, and there will be surprises. In fact, we should assume that there's going to be discontinuity. More people died from infections than heart attacks before penicillin. You know, taxis were taxis before Uber. Trading was trading until indexing. So industries constantly go through disruptions. As I travel the climate world, I'm running into disruptions that are about to happen at any time. I can't yet tell you which will happen, but I would bet on the field. There are going to be discontinuities that break our way. Our goal is to position for them. The second thing I'd point out on the green shoot side is understand the power of cost curves. Think about cell phones. In about 2000, they hit a whole new level, and suddenly they were ubiquitous. It changed how video conferencing came out in 1964, but it was $5,300 an hour. When it's free, things work very differently. In the climate world, you are watching some of the most powerful industrial cost curves I've ever seen. 28% for solar, that is double a normal industry. And these cost curves, while they look linear, they hit points, like right about now when solar becomes dramatically cheaper, things happen. We can predict the cost curves. We can't predict how the market changed.
So then why that word cloud of pessimism?
Well, I think in some ways, the voices that got us to this key moment have been calling out the need. And part of the reason I'm on the stage, I don't do many conferences, is we need to change our voices a little. We need to also make sure that we're looking for that opportunity. And we're looking for Colin Powell once said about leadership is that optimism is a force multiplier. We have to find a little bit of optimism. That is not to deny that this is tough. And the last thing on optimism is, you know, when things like this conference happen where you get many parts of society, policy members, activists working together, things happen.
Yeah.
Anyone remember the population bomb? 30 printings back in 1968. We were going to be out of food. Los Angeles, the smog was awful. I was in Beijing 3 weeks ago. The skies were clear. The ozone layer is actually going the other way now. With time and with action, I think we can make progress. And that green shoots are something we need to grab a hold of.
All right, so I'm going to go counter then for my next for my next question, which is the whataboutisms.
Yeah, we also, as well as some optimism, we have to basically not fall for whataboutism.
Yeah.
And, you know, one of the interesting things that's happened, if you look online and at social media, the attacks of climate deniers have flattened, but the attacks on climate solutions have gone up. And these are whataboutisms. Now, whataboutisms is a term that came from the 70s with the Irish Republican Army. Whenever they would do something, they'd say, what about the British soldiers? And Soviet propaganda uses whataboutisms. When Chernobyl hits, it's what about 3 Mile Island? And whataboutisms have hit now an absolute art form in today's politics. Let me just kind of show you what that sounds like.
What about those 21 Democrats?
What about beings that have
more oil.
What about the Buddhists? What about the alt-left that came charging at the, as you say, the alt-right? What about us? What about me? What about terrorism?
Oh, what about Benghazi? What about the blatant lies that the Obama administration told us? What about the fact that Ben Rhodes bragged about lying to the media and the public about the Iran deal?
Whenever a pundit or a politician starts with what about, be prepared to be deflected and potentially deceived. So whatabouts are rampant in climate. Like, what about EVs?
Right.
Aren't they dirtier? Well, yes, when it leaves a factory, because you have the battery in it, it's slightly more emissions at manufacture. But once it gets on the road, an EV is 90% more efficient and uses 1/3 of the emissions over its lifetime. It's a ridiculous argument. Or what about solar panels in China? Yes, they take some of the power from a grid that is still dirty and they generate emissions. But if you look at the numbers, those emissions are replaced in 3 months of their 25-year life. Are we not supposed to use solar panels because we're trying to replace a grid that's dirty? We can never replace it if we don't start using them. It's a circular argument. Or one of my favorites is basically the pessimism and whataboutism with materials. Yes, we have a lot of work to do. We can find oil in the North Sea. We can't find lithium. Like, if you look at what happened in lithium, we went from worried we'd never have enough lithium to a massive oversupply in 2 years. So my point here is, as we're going down this path, we have to make sure that we don't get caught in the whataboutisms. And I always say, like, you know, what about doing the work?
Yeah.
And what about solving the problem?
And so how do you institutionalize, or how do you sort of create, I mean, because part of this is perception, part of this is the dialogue, part of this, you know, we saw a lot of cable news clips, and between cable news and social media, it picks up a lot of steam. So what can a group like this of the what about we do the work folks do?
It's exactly that. I think one of the things I've learned in climate, and to your earlier question of why I've gone deep, is you cannot be a tourist in climate. You can't just sort of pop in and think you know the answer. This is an immensely complicated revolution that we're going through. I don't think I have to tell this room because you're here, but we have to encourage people to do the work and not simply fall back on how things are done now.
Right.
Just as an aside here, you have to understand what we're doing is a simplification problem. I want you to think about our current energy system. You want to turn on a light. How does that work? Well, first of all, 50 million years ago, the sun shines. It's captured in a tree. The tree falls down. For 50 million years, it gets subsumed under thousands of feet. We then take an iron pipe. We put it down 10,000 feet. We turn it right. We put in water. We crack rock. We bring up a vapor. The vapor goes in 3 million miles of pipe. We wash it in a $250 million natural gas processing plant. We put it in 3 million miles of pipe again. We put it to $1 billion gas turbine. We basically blow it up, releasing a molecule that can destroy the world, and we have an electron. The other way to do that is we can get sun from this afternoon, hit a silicon panel. There's silicon everywhere, and we have an electron.
Yeah.
So it seems hard to do. I mean, this is hard to do, but what we're doing is hard.
Yeah.
So, like, why not make it a little more simple?
All right, so that takes me to the third one that I wanted to touch on with you, which is the policy box, because this is a room of doers, as you mentioned. It's not totally simple how we get this done, and it requires a bunch of different angles. So tell us about the policy side.
Yeah, I think we have had an enormous gift, and we've picked up an enormous set of allies in the recent policy wave. And I'm often asked, like, are you nervous investing in areas that have subsidies? I'm nervous investing in food. I mean, there's 400 million of subsidies in
Right.
European food. Healthcare, like, that's subsidized. And if you think about the IRA, it's about $76 billion a year. We are subsidizing fossil fuels around the world at close to $700 billion a year. So it's not just about subsidies, it's are they settled, and has it become part of the landscape in a way we can count on? And, you know, it's staggering what's happened in the last 4 years. If you look at it, you know, the U.S. in three bills, it's close to $600 billion. If you go to Europe, they've pledged $1.6 trillion. You can never really tell in Europe where the dollars are there, but it's been pledged. China, the only part of investment that grew in China last year is green sector of their economy. And, you know, it's not just there. It's India, which is all in, Australia. You know, Australia has a Green New Deal, and I could go on and on around the world. You know, Kenya, Malaysia. The world has decided, much like healthcare, much like education, that this is an area that needs to be subsidized. But what's important is actually not the numbers, and this has been a light going off for me. It's the shape. So the original policy dilemma was a balance beam, affordability and sustainability. And as I showed you, the affordability is getting better. But what happened is we've now changed the shape of policy. With the Ukraine, suddenly Europe and around the world realized that they could not count on the current system for energy security. If you want energy security and you don't have oil and gas, you got to go green.
Right.
So suddenly, green had a new ally, which was security. And then a fourth ally picked up, because if you look at the IRA, probably the key part of it, and the reason Macron was so mad at us, was there was a industrial policy to it, a reindustrialization of the country. 270,000 jobs in the U.S., millions of jobs in China. They figured out in China that for every job that they lose in the fossil fuel industry, they pick up 4.5 in the green. So suddenly, this debate that many of us in the room have been rooting for, the environmentalists, the activists, got new allies, and those new allies are called energy security and jobs.
Right.
And those allies are showing up in weird places. One of the reasons that I'm maybe less worried about policy right now changing with an administration is the money has gone to the red states. The blue states voted for it. The money has gone to the red states. And so your new set of allies looks like this.
In the heart of Texas, green jobs are booming.
But increasingly, Wyoming's energy comes not from mining what's down below, but from mining the wind above.
Different kind of farm in Crittenden County is planting the seeds to grow jobs and produce green energy.
Texas is seeing a boom in renewable energy, and that means more companies are hiring.
The governors of Oklahoma, Arkansas, and Louisiana announced the hydrogen partnership this week.
But essentially now, politicians are in a box. If we did away with the IRA, we do away with a lot of jobs. And are the politicians that have been cutting ribbons willing to shut the factories down?
And do you think, we're headed for, I think it's fair to say, quite an election. Do you have confidence? Do you have real confidence that a new administration, a non-democratic administration, will continue to invest here?
As my partner Hank Paulson said, if some of the things happening in politics happen here, this is maybe number 10 on my list.
Yeah.
So I can't have confidence about a lot of things.
Right.
But what I can say is these allies of jobs make a difference.
And Texas is a fascinating example of that, because clearly not a lot better than that place. All right, we just have a couple minutes left. Let's talk about passing the baton briefly, because I feel like that's a nice sort of way to send this audience off, or send us off, I guess, and give them something to chew on.
Yeah, so one of the things I'm watching, and this is important, it's an important moment, is a bit of a passing the baton of a race that we're all running together. And I think it's a very positive thing. We should celebrate it. In certain types of human endeavor, there tends to be a little bit of a relay race. This is an Olympic year or something, thinking relays. And it often starts with the scientists. Think about Niels Bohr, the ARPANET scientists, Mariko and Wiseman. Then it moves on to the prophets. The people tell us we need to pay attention. Einstein sends a note to FDR, says you got to think about this bond thing. Gates talks about pandemics. It then moves to the policymakers. And finally, it moves kind of to the people who then have to get it done, the people in this room and elsewhere that have to get it done.
I do love that young, handsome Al Gore up there.
How about that, huh? He invented the internet.
Quite a callback.
He didn't invent the internet, but he helped empower it.
Yeah.
Right? And so this relay race happens over and over again. And if you think about what's been happening in climate, we owe so much to the scientists, Yoshino, Keeling, who's got us started. right? And then the people that have called out the need, right? We owe so much to this. The policymakers, as I just showed you, stepped up. You know, part of the reason I'm on this stage is the rest of us have to step up.
Yeah.
There's a passing of a baton that needs to happen to people. That's what, to answer your question, that's what we're trying to do.
And so, less than a minute, given everything that you've just told us, clearly you've thought about this a little bit. What does this room do? Like, what do you send them off with to, what's something that they can take home and say to their families, say to their partners, say to their kids about the next step that they need to take, given that you represent the money side of this?
Yeah, I think the money is going to start moving because the opportunity is there. But I think importantly, we need to take a bias to action and a touch of optimism. So one of the things that happens in a relay race is the last leg is sometimes the fastest. And what surprised people historically is when you look at the time, I mean, after 30 years of the atomic revolution, Oppenheimer stepped in and won a war, won 7 Oscars, right? It's like, so I think there's an optimism here that we can get this moving. We may not be moving fast enough, but we are moving faster. And the path to progress and perfection starts with progress.
Right.
And I see that, I think that's happening, and the passing of the baton will accelerate it. So let's have some hope.
All right, and let's get to work. Jim Coulter, thank you very much. Thank you, everyone.
Well, there you have it. Bloomberg Originals chief correspondent Jason Kelly sitting there with a TPG founding partner and managing partner of TPG Rise Climate, Jim Coulter, live here on the green stage at the Bloomberg Green Festival here in Seattle. Well, from the green stage to Wall Street, we're looking at quite the rotation when it comes to stocks today, out of mega cap tech stocks and into smaller companies, with the Russell 2000 having its best day of the year. It's all the result of a reset that we saw in yields, lower across the curve, following a cooler than expected inflation report. And for more, we turn now to Bloomberg economics editor Molly Smith, who joins us back at Bloomberg headquarters in New York. Molly, you take a look at EcoGo on the Bloomberg terminal, and this inflation report came in below expectations in every single category. Give us the highlights. Is this the most Fed-friendly inflation report that we've seen in quite some time?
It would definitely be hard to find another one, especially when you take this in combination with the May CPI report, which Powell this week had described as being, quote, really good. So would be curious to see how he describes this one. You know, he was pretty cautious this week in his testimony to lawmakers, saying he doesn't have the confidence yet that inflation is sustainably heading toward 2%. He said that before today's report. I'm curious now how his thinking may have changed, given that this is definitely more a signal that we're on that path. And the key here was housing. This was really finally the long-awaited slowdown we've wanted to see in shelter categories. Both, you know, some of those key indicators rising at the slowest pace since 2021, and that is such a huge weight in the overall CPI index that, you know, thankfully other categories came down as well, but that was the really big driver today.
Why is that, Molly? What's happening when it comes to housing in the U.S. where we saw prices actually cool a little bit? Or I should say inflation cool a little bit?
Right. So, I mean, it's, you know, it's so hard sometimes to talk about the housing market at a national level because it is really a very regional, zip code by zip code kind of story. But there were some outliers in the May CPI report that reversed a bit in June. So that was helpful, especially in the metro areas of New York and Boston. But generally, you know, housing inflation has just been such a stubborn category. We have this structural supply shortage of housing in the U.S., and that's not really going to go away until we get more supply coming on. We need builders to be building more homes, and you know, that's tough if the demand for housing is not there because rates and prices are so high. So we're still in a bit of a catch-22 here, that builders are trying to create more inventory, but it's just, you know, there's so much more that's needed and at much lower price points.
Our thanks to Bloomberg economics editor Molly Smith joining us from Bloomberg headquarters in New York. Now back to the green stage here in Seattle at the Bloomberg Green Festival, where we find Carol Massar, my co-host. She has a discussion in progress right now on using platforms to affect change. She's joined by Sue Bird, WNBA legend, and also Kara Hurst, the Chief Sustainability Officer over at Amazon.
To be net zero carbon by 2040, that's 10 years ahead of the Paris Agreement. And we set that looking at the science and saying, we think we're in this decisive decade. We know we need to move faster. We have a lot of optimism about doing that, but we can't go alone. And we're excited that over 500 organizations and other companies have joined us in that. But we want to send these really strong demand signals, and we want to also put our own resources towards that. So we've been doing things like purchasing renewable energy. We're the largest corporate purchaser of renewable energy in the world. We have been for the last 4 years. We announced yesterday we've actually hit 100% renewable energy across our global operations, which is a huge feat. We have over 500 projects.
Exactly.
Around the world. We've got 24,000 electric delivery vehicles on the road already. We've got one of the world's largest electric charging infrastructure kind of operations going. We've just got, we look at all the different aspects of our operations and think about how do we make it more sustainable on behalf of our customer. We want to reduce waste. We took out those plastic air pillows. We took out 95% of those in North America. So we want to make a sustainable company and do it on behalf of our customer.
Sue, I want to bring you into it. You are part of a group of very elite athletes. And when we use the word legendary, it doesn't apply to everybody, but it definitely applies to you. So kudos. That platform, though, has been a couple of decades in the making and then some. How do you think about your platform and the responsibility of how you use it?
Yeah, women's sports is at an interesting moment, especially women's basketball. And for
a good interesting, right?
Yeah, no, great interesting. Great interesting. But what's interesting about it, maybe in a negative sense, is while the coverage has increased, what I've noticed is it's not always accurate. And it's really had me take a step back and be like, first of all, what else is inaccurate out there being told to us, by trusted, places, other trusted platforms. So I think for me, when it comes to my platform, for so long while I was playing, it was about, bring a certain understanding to the game, right? Using my platform for all kinds of good. Now I'm like, wait a minute, I got to make sure the stories that are being told are accurate. I got to make sure that when people are tuning into a game, they have a full understanding. So that's really where I feel like I can use my platform now as a retired player.
It's also the way women athletes have been portrayed. Like I was reading some things about the Olympics coming up and the Olympic Committee, how they've been changing some of the standards and updating in terms of how they want media representation of women. And it's not just how they look or kind of superficial stuff, but really just what they are achieving. That's important.
So important, so important. I think what's beautiful about women, especially women's athletes, is we are dynamic. We've had to be, for so long we weren't getting the coverage that we deserve. We weren't getting the credibility. So we had to have different parts of us. So I think it is great to highlight those things, but to your point, not just about appearance, not just about these artificial things. So I love that the Olympic Committee is doing that.
I want to talk a little bit about the climate pledge. So I'm curious, Kara, when you have conversations with companies, what is it? Is it tough to get them to sign on, or tell us kind of the environment here?
Yeah, I think it's a huge commitment to sign on, and it certainly takes resources. And so I think it takes a leap of faith, too. Not all of us know how we're going to get there. There are some things we know how to do, like electrifying fleet, and then there are other things like aviation, where we know sustainable aviation fuel is part of it, but we don't know all of the solves. And so some of it is a bit of jumping into the fray and saying, we know some of how we're going to get there, and also we need to partner to figure out some of the other ways which we don't necessarily know. And we need to change the game, right? So we need to figure out how we're going to come together and make new decisions together, put resources together, and also public-private partnerships are a big part of it. So how do we come together and work in the cities where we all have employees or we have operations and get cities to change their infrastructure, and build differently the buildings that we're in, or put more rail in, or change our, the ways in which people commute, and those kind of things as well.
Well, Sue, was it like a no-brainer for the Storm to sign the climate pledge?
I was playing then, so I wasn't in those rooms. But
that's true.
Yes, but knowing our franchise, knowing the ownership group, I'm sure it was a no-brainer. They're very much an ownership group that wants to help the world change. I mean, it's a big statement, but at the same time, when you find the ways that you can have that impact, It's really not that big of a statement. You can really change the world.
I always think about, like, you know, we all set out on a course, whether we go to school or we start working and we think we're going to go this way and then we start going a different way. And I'm curious about, Sue, like, what motivates you and how maybe that has evolved over the years to where you are today?
Yeah, well, I'm very lucky. I say this from the start. To be an athlete, when you think back to childhood, when I think back to my childhood, I was just a kid that really liked playing. Like, I just loved playing sports, and how lucky am I that that led to an actual career where I graduate college and immediately I have a job, a profession waiting for me. So I was super lucky in that sense. But throughout my career, motivations change, right?
Yeah.
There's the motivation early of maybe wanting to prove yourself in a field, right? You haven't, in my world, I haven't won the championship yet. I haven't won awards yet. So I have this grit about me that I want to prove it. But then that flips when you have done it, and now you have to prove that it wasn't a fluke. And now you have to sustain, and now you have to stay, for lack of a better, on top of that mountain, which has a whole other type of challenge. And for me, as I kept doing that, then it became, okay, I've won the things. Now how can I actually have an impact on this? So it's really interesting how through the course of my career, I've had these different moments, these different types of mountains, and trying to figure out how to stay motivated. And again, I'm lucky. I play a team sport. A lot of my motivation came within the locker room, within my team. I had teammates to look to, whether they were pushing me or I was pushing them seeing me succeed, me seeing them succeed. And that's really a big motivating factor for me.
What about for you, Kara, in terms of your job? And I think about your career, too. You've been in Silicon Valley, different worlds in terms of sustainability. How do you think about, like, what motivates you in terms of your choices and then wanting to be part of Amazon and their mission?
Yeah, I think it's really interesting. I've worked in NGOs, I've worked in government, I've worked in now corporate America. And I think, you know, being on those teams and thinking about the different languages you have to be able to speak, I'm impact oriented. So what I really have been motivated by is trying to figure out a way. I've always wanted to make a difference, wanted to make an impact on the world. I've worked on human rights issues, I've worked on environmental issues, and I want to figure out what is, like, how do I use the resources and the scale of whatever I'm working on to kind of make that change. And in NGOs, you have influence in a different way. Government, you have scale, you have policy changes you can make. In corporate America, you have resources and you have a different kind of scale. And you have to kind of speak the language of the different team that you're on and the different kind of context you're in, but you have to remain authentic to yourself and you know, lead in the way that's going to make the folks around you understand the impact that you're trying to make and the context that you're in.
How do you guys think about the next generation in particular? And Sue, let me go over to you. You know, I think about the next, you really kind of changed the game, no pun intended, in terms of the attention that you've brought to certainly women's sports, women's basketball, on the college level, and then, of course, on the professional level. Like, you made a difference. Like, it's huge. And I think young women need to see that. So how do you think about that?
I mean, I've always taken great pride in that. I think what's amazing about this younger generation, and I can kind of tell the story within a story, if you will. When I got towards the end of my career and we were doing things like CBA negotiations, it was really the younger players. So if I'm, by the way, at this point I was like 37 and I was considered old. I'm still like
that's so
figuring
unfair.
that out. I'm like, wait a minute, am I old? Am I young? But we had, you know, the younger players at that point in the WNBA were 21 to, let's say, 25, right? Like this age range. And for me, I had grown up in a era where we were fighting, but also just happy to have a league in a sense.
Yeah.
You know, and I hesitate to use this term, but we're all very familiar with the shut up and dribble, cringe. But that's really how it was a little bit. We were happy to have a league. We didn't want to push too hard because, we don't want this taken away from us. And now, like I said, I'm in my late 30s, these players in their early 20s, so this younger generation you're alluding to, they were like, no. Like, we need charters. We need charter flights. What are we talking about? Like, no. This locker room, not good enough. And they really, it wasn't an entitlement as much as it was, this is what we deserve.
Right.
This is what's right. And I think the combination of the two generations, if you will, in our last CBA negotiation is really what got us to a really promising place, and it really set us up for the future.
Kara, for you, and I know we've talked about sustainability is something that a younger generation looks about. I have a 21-year-old daughter, and she's turning things over, looking at ingredients. Where was this made? What's the carbon footprint?
Sure.
Like, they matter, and they care.
They do.
So how do you think about what you guys need to do at Amazon in terms of the next generation?
Yeah, I think increasingly this next generation, they both care a lot, they're incredibly passionate, and they have a lot of anxiety about what's coming and what the state of the world is. And so one of the things I think is our responsibility is, one, to act fast, to drive big solutions, but also to bring some optimism to it. We have time. We don't have a lot of time. We're in this decisive decade where we have to act now.
Right.
We have to move very quickly. And so I think one of the things that we need to lead on is to show that there are solutions, but we need to deploy them now. We cannot wait any longer. So one of the things leaders need to do is to take those decisive actions. We need to make changes now, and we need to make them at scale.
So I want to ask you.
Well, that right now is Carol Masser's panel, along with Sue Bird, WNBA's all-time winningest player and co-founder of the media commerce company Together and the production company A Touch More. Also with Kara Hurst, Chief Sustainability Officer over at Amazon. We're live here at the Bloomberg Green Festival. Check out Carol's panel on Live Go on the Bloomberg terminal. Now to someone who's also participating in the festival here, but first a little bit of setup. You might recall yesterday how we talked about how an estimated 11% of global greenhouse gas emissions are due to tourism, and that's predicted to double by 2050. It's the year that scientists have forecast as the tipping point for all sorts of ecological disasters. Worldwide aviation actually accounts for 2% of all carbon dioxide emissions and 12% of all CO2 emissions from transportation. So how can tourism and airplane travel fix its emissions problem? Some argue that the answer is 100% sustainable aviation fuel, and that'll play a big role. Curbing our long-haul international flights, too, will certainly be something that you have to keep an eye on as well. Our next guest thinks about this constantly. He's participating in a panel at the Bloomberg Green Festival about fueling airlines' decarbonization journey. Pleased to welcome Ryan Spees. He's Managing Director of Sustainability at Alaska Airlines. He's here at the Bloomberg Green Festival in Seattle. Ryan, welcome. Good to see you.
Thank you so much. It's great to be here.
Okay, so sustainable aviation fuel. It kind of sounds too good to be true. What exactly is it? Because right now it's just a tiny, tiny, tiny portion of the fuel that airlines use.
Yeah, SAF, or sustainable aviation fuel, is, it can be almost like a miracle drug, but that doesn't exist in any quantities that we really need today. Sustainable aviation fuel can be made from things like fats and greases, oils. That's primarily what we're seeing today. But the next generation of those things is really where the fun science comes into play and where the carbon emissions comes down quite a bit.
Is it always made of byproducts, or are there certain crops that could be grown just for producing this fuel?
So we haven't seen any crops grown directly for producing it. You're usually using byproducts, but the future technologies is actually all about pulling CO2 out of the air and transforming that with renewable energy and renewable hydrogen into jet fuel. It's something that can be dropped right into planes today, which is really exciting, right? You're not worried about taking the farm and making it into fuel.
Okay, I mentioned it's just a drop in the bucket right now. The aviation fuel management software provider i6 Group says that only 0.1% of all jet fuel that's used worldwide is sustainable aviation fuel, and that has remained level in the last 4 years.
That number is definitely growing. It's certainly, we're seeing about 1% right now, and we're actually having demand much more every day. And so what we're seeing, and what the challenge is how do you scale up an industry that is 3 to 4 times more expensive than the industry that exists today? And so, we're thinking about technologies and investments, and where can we, as an airline, which doesn't have incredibly robust margins, spend our dollar wisely and spend the dollar of our guests wisely, so that we're making the right choice for them, but also the planet. Really challenging.
So 1 gallon of sustainable aviation fuel is literally 3 to 4 times more expensive than a gallon of conventional?
Yeah, that's right.
Okay. Where are you getting it right now?
So primarily we're getting it out of a group in Montana that's doing fats, oils, and esters, and we're sending that to our Los Angeles airport and San Francisco airport.
How do you bring these costs down?
It's a great question. One is investment, but really the idea here today is finding great partners. So innovation happens in a lot of places, and that's why the Bloomberg Green Fest being here is an amazing opportunity to meet with our partners, folks like Microsoft, folks like Amazon, that have a vested interest in how do they bring their emissions down when they're traveling with their employees. And so finding those partnerships to help us offset that green premium is part of it. It's the deal with any scaling operation, right? How do we get more? We need to induce more demand, and we need to kind of keep that train rolling and having partners that help us along the way.
But are you just able to induce that demand by getting large corporate customers to pay more?
No, and that's actually a really exciting thing that Alaska has done. So we've engaged our guests on this journey as well. Back in December, we offered a promotion that if you bought sustainable aviation fuel with us, you got some elite qualifying miles. We sold over 500,000 gallons of SAF in December alone. In May of this year, we just offered that to our guests to do it in the bypass. So the first U.S. company to do that, where when you're buying your ticket, if you want to offset a piece of your flight, 5, 10, 20%, you can do that. You can help contribute, and every sort of piece helps. That's not the only thing as well, right? It's not just how do I get a guest to help me pay for this, or how do I find a corporate to help me balance this. It's also thinking about policy. Policy is incredibly important, and one that we've seen on the federal level with the Inflation Reduction Act has certainly helped. We want to take that a step further. We see credits expiring. How do we extend those? So there's so many levers that we need to be really engaged with, and at Alaska we are.
Does the lever need to be pulled by the government, by governments outside of the U.S. as well as by governments in the U.S.?
You're seeing both, right? So in Europe, it's much more of a stick approach, right? Mandates on percentages of SAF that you have to use. That's just sort of come into place, so we'll see how that market develops. Obviously, we're a much more carrot-focused market here in the U.S., and so you see incentives for building, you see incentives for delivering, and those are a different approach, and we're both going to see how this plays out. But I think both are really important, and so it's exciting to see how this industry will grow.
You sometimes hear terminology that doesn't exactly match what people think it means. So when you talk about sustainable aviation fuel, is it actually sustainable?
Yeah, I mean, you look at the life cycle, the science is certainly there behind it, but the challenge is not all SAF is equal, right? Each one might have a different carbon content or a life cycle carbon emissions associated with it. And so explaining that level of detail is challenging. We're always trying to think about it, not in just dollar per gallon, but dollar per ton. How much does it cost to reduce a ton of CO2? And we're thinking about that number, and that's what our guests are thinking about, and that's what our corporate clients are thinking about.
So what's the byproduct that's created when an engine burns sustainable aviation fuel?
It is CO2, so it's still burning it. The thing about sustainable aviation fuel is you're looking at the entire life cycle of how the fuel is actually made, right? Whether you're pulling fossil fuels out of the ground, which is traditional jet fuel, or you're using some lower carbon material in the production and process and transportation of that fuel. So at the end of the day, you're still burning some CO2, but if you look at the full life cycle, much reduced with SAF.
So how much does it decrease the carbon output of a traditional flight if it's still emitting CO2?
Yeah, so you're looking at, with SAF today, about a 40% reduction if you're putting that in a plane in the total life cycle. Our hope is to get up to 80 or 100% with the e-fuels that we talked about earlier.
Is this the only part of the solution when it comes to
It is
the impact that airlines have on the climate?
I would say it's the short and medium-term solution for many flights and the long-term solution for long-haul flights. We believe in battery technology, but we believe that there's an opportunity for hydrogen to play a part. But those things don't scale quite at the same rate. If you think about flying from here in Seattle to New York, by the time you land today, or if you took that flight, the weight of the aircraft has gone down tremendously. If you do that with batteries, it's still the same weight. So you're really fundamentally fighting against something that's physics. And so we think that for those short and medium haul flights, new technologies will absolutely start to take hold. SAF will be there for the long term.
What about hydrogen?
We made an investment and actually donated a plane to Zero Avia, so they're looking at...
Yeah, we're joined by the CEO and founder later on the program.
Yeah, it's super exciting and an incredible talk. I know that we're all anxiously waiting for. That's a technology where we think, hey, there's some promise here. There's still a lot of infrastructure challenges with hydrogen. There's still a lot of, how do I get that to my airport? But we are investing and encouraged by it. but we'll see where it plays out.
Not to mention the production of the actual hydrogen, and it can be energy intensive too.
Very energy intensive, but that's the case with all these fuels at this point, right? And so we're encouraged by renewable energy, obviously dominating every new piece of energy that's going in the market, and that would help on the hydrogen side as well.
So right now, if you look at the fuel usage of Alaska Airlines, what portion is sustainable aviation fuel?
We are about 1%, and like most airlines here in the U.S., our goal is by 2030 to hit a 10% goal. It will be a challenge without all of those levers pulled at the same time.
Is it a realistic goal?
I think it is. I think the challenge is today, right? So we're speaking on stage with John from Sky Energy and Microsoft on how do we get this plant built. So I think that there are absolutely opportunities to get us there. Not going to say it's going to be easy.
It's also, if you think about the sustainability element, you said you have a facility in Montana that you work with, and then you have to get that fuel then to the West Coast.
Yeah.
That's not exactly, carbon neutral.
Right. The infrastructure challenge is its own beast, especially here in the Pacific Northwest. We have some real challenges with getting SAF into SeaTac. So how do we solve those? Working with policymakers, working with partners, working with traditional oil and gas to solve some of those challenges. But yeah, I mean, most people don't ask where they're getting their jet fuel from in the start. So.
Yeah, that certainly makes sense. Do you think that we'll start to see traditional energy companies that make conventional aviation fuel get into this market?
I think they've dabbled. I think they're a bit waiting on the sidelines to see, is the demand really there?
Is it?
Yeah.
It sounds like it is, because if the goal is 10% by 2030, then the demand is there.
The demand is, the intention is there, right? But the demand to pay for it is still developing, right? And I think that'll be the biggest challenge. And honestly, if you're looking at the oil and gas markets, they're worried about their margins too. So they're doing what they need to do.
Well, one of our Bloomberg Intelligence commodities analysts, Mike McGlone, always says the cure for high prices is high prices. So if you have something that's high priced, you get more people coming into that market. It's just basic economics, right? Do we get to a point where you get so many people coming into the market because they see demand for it that you see price to fall in the coming years?
Absolutely, and that's where I think engaging our guests and engaging corporates and telling those stories about the demand that we have will encourage and will, hopefully incent production in the places that we need it the most.
Ryan Spies, Managing Director of Sustainability at Alaska Airlines, here from the Bloomberg Green Festival in Seattle. Ryan, thanks so much for joining us
on
Business Week. Really do appreciate it. Let's head on over back to New York for an update on Wall Street, where we find Charlie Pellet with the latest in business news as well. Hey, Charlie.
Hey, thank you very much, Tim. Indeed, looking at a major rotation for the U.S. stock market on this CPI Thursday. Right to the numbers here. Yes, the Dow is higher, up 38 points right now, a gain of about 0.1%. The Dow 39,756, but the S&P is now retreating 45, back below 5,600, 55.88 on the S&P, down 0.8%. NASDAQ Composite Index, a lot of damage there today, down 340, a drop right now of 1.8%, but an interesting day in terms of the rotation theme. The Russell 2000 Index of small cap shares up 3.4%, the Russell 2000 having its best day of the year. Dow Transport's higher as well, up by 2%. 10-year, 4.19%. The 2-year, 4.50%. Spot gold up $45 the ounce now, up 1.9%. 24.16, and West Texas Intermediate crude up 0.9%. 82.80 for a barrel of WTI. Wall Street traders are betting that the Federal Reserve will be able to cut interest rates soon. They sent bond yields tumbling while driving a strong stock market rotation. Earnings news. PepsiCo did report weaker than expected revenue growth as its snack food business was hurt by increasingly budget-focused shoppers and a recent Quaker Oats recall. PepsiCo shares, they're up 0.3% after earnings. Rival Coca-Cola up by 0.7%. Of course, the big earnings event for the week happens tomorrow morning before the open of trading, when we hear from JP Morgan Chase, Citigroup, and Wells Fargo. JP Morgan Chase up now by 0.1%. Citigroup right now lower by 1.8%. Wells Fargo back in the green, up by 1.4%. So again, recapping here, a very mixed market today. The Dow holding on to a gain of 0.1%. S&P lower by 0.8, and the Russell 2000 surging 3.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, you know how the saying goes, this person needs no introduction, and it certainly stands true for our next guest. We are going to give her an introduction anyway, though. Gina McCarthy is a former U.S. EPA administrator under President Obama and the first White House National Climate Advisor appointed by President Biden. Gina is managing co-chair of the America is All In Coalition. It's a coalition of leaders assembled in support of climate action here in the United States, which is also led and supported by Michael Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Gina, also an operating advisor at Pegasus Capital Advisors and a senior advisor at TPG Rise Climate Fund. There's a lot more, but we'd run out of time if I read it all. Bottom line, she knows a ton about energy and climate change. She's with us here in Seattle at the Bloomberg Green Festival. Gina, how are you?
Great, great. How about yourself?
Doing well. Welcome to the program.
Busy place. It looks like it's a buzz.
Hey, the energy's great, isn't it?
Yeah, it really is.
What's the most important?
As long as it's clean.
Yeah, okay, there we go. I like that. What's the most important conversation today involving climate change?
Well, probably it begins with an admittance that we're not doing as well as we can and we've got to scale up. And I think that really then lends itself to talking a lot about partnerships. You know, we have a lot of good companies that are here represented, but honestly, we need more partnerships both across the U.S. and internationally to really tackle this at the scale that it deserves.
What type of partnerships? Because I was just speaking with Ryan Spees over at Alaska Airlines, and they're really relying on corporate partners to drive the change in sustainable aviation fuel because it costs 3 to 4 times as much per gallon than conventional fuel. So he wants the companies to pay more because they want to travel sustainably for business. Is that the type of partnership you mean?
I think it is about public-private partnerships. You know, so I mean, clearly the Inflation Reduction Act was an opportunity to give some public money to drive a whole lot more private investment. And we have to start thinking that way. I don't think it's either or. I actually think it's those partnerships that are going to drive this in a way that actually provides meaningful scaling of this opportunity, not just in the U.S., but globally.
Okay, where's the government involvement? You mentioned the Inflation Reduction Act.
Yes.
In your view, is that just the tip of the iceberg? Do we need more?
Well, we saw immediately after that happened, we saw the EU start driving new changes in Germany. So it's begun to take off, and people are realizing that it's a way for the public and private sector to really join together so that both of them can win. This is not about, you know, spending so much money in the private sector that you can't afford to do the deals. This is about how do we make these deals affordable by connecting public and private. But there's still a lot of opportunities for private companies to accelerate their markets, and they're going to take advantage of that, and we should let them.
You've worked in both Republican and Democratic administrations. Why and when did the idea of climate change become so political in your view?
You know, it started off being pretty political because it took a whole lot longer time than it should have for us to recognize that this was a legitimate issue. And so now, of course, it still remains fairly political, but honestly, the politics starts to move out when you realize that the kind of technologies and opportunities we have today are going to make people's lives better. If it's going to keep us healthier, it's going to save us money, if it's going to create real jobs, which is what we're seeing today, the politics may still be there, but it doesn't have the punch it used to.
How much, speaking of politics, of America remains all in if it elects Trump in November, given his promises to eliminate what he calls the EV mandate, target offshore wind, and pull the U.S. out of the Paris Climate Agreement?
Look, I have every expectation that what he said he's going to do, he's going to do. So that should give you your answer. I don't see the United States or globally the kind of progression we need on climate if we don't elect someone who understands climate and wants to move those issues forward.
And in your view, that is not the former president?
That is correct.
I want to welcome in Carol Masser, who just came running from the green stage. Great panel.
Thank you very much, because I did not want to miss talking with you.
Oh, thank you.
And we were just talking with Kara Hurst over to Amazon and also Sue Bird of the WNBA, and just the importance of platforms. But I'm listening to you guys. First of all, pleasure to meet you.
You too.
About politics. Are you scared in terms of what might happen in November?
And I think everybody should, because what's at stake is not just climate, which is the existential challenge of our time, but it's fundamentally our democracy.
Well, and it's interesting that you talk about, because Are you concerned from climate, first of all, that we would go off in a very different direction? We would be more isolated? Because climate obviously has no borders, right? So never before have we needed to work together with everybody.
You know, we were just talking about that. It's going to take public-private partnerships, and it's going to take the U.S. and the other developed world to start investing in the developing world if we want to make this work. And those investments can't be coal. They can't be more natural gas. They've got to be the shift to clean energy and transportation that we know we can do.
Well, it is interesting because we know the U.S. pulled out of the Paris Agreement under Donald Trump, then President Donald Trump. He threatened to do it again if he's elected in November. You have pointed to, though, in terms of climate progress that's made by states, by cities, like the local level. I think about, we're going to be talking with the mayor of Seattle. Like the local level really matters too.
You know, that's really what Bloomberg's America All-In program is all about. And it's more than 5,000 people are joining together. And that's because subnational governments matter. If you remember when Trump was president before, the effort was to make sure that states and cities stood up and held the ground and kept moving forward. And that's exactly what happened. So we need to make sure that we're not going back again and revisiting that. We need to actually keep moving forward with all of the breadth of expertise and experience we now have that says that we can win this climate battle if we have the courage to stand up against folks that are deniers and start really supporting those folks who know what the future needs to be.
You were talking about the Inflation Reduction Act, the investment in clean tech manufacturing, clean energy projects under Biden, fed by the IRA. How much of that endures regardless of what happens at the polls in November? How durable is the investment that's been unleashed by the IRA and other policies that could be pared back if Trump wins the White House? Like, how vulnerable is it?
Yeah, when you look at the money, we're talking about something like $361 billion, right?
Right.
And this is just the start. This is a 10-year program. We just had our second birthday, I think.
Yeah.
So we have a long way to go. And we're talking about job growth that's in the plus 300,000 plus new jobs, right? These things matter to people. Human beings care about this. And so these are benefits that people can see and feel and taste. So that's why I believe will there be challenges? Absolutely. I expect that under a Republican administration, you're going to see lots of folks wanting to pull that out. You're already seeing bills in Congress being proposed to get rid of this and that. But when push comes to shove, we have more money going to Republican districts that are now building the manufacturing plants that they don't want to shut down. So if they want to go against their own constituents and their benefits, then more power to them if they want to risk it. But I don't think that's going to be the case. I think we're going to hold the fort. We'll lose some. There'll be challenges, I think, internationally, but not just pulling out of NATO even. But these are the things, the large things that we have to think about that could be at risk.
30 seconds, Gina.
Yes.
I'm thinking about everybody who's listening.
Yep.
What's the one thing every individual, take politics out, should be asking themselves when it comes to the climate environment?
What do they want as a future for their kids? What do they see right now as the challenges that they're facing? We can no longer hide from the climate impacts, but what we can do is grab a clean energy future for our kids. That's how we're all going to win.
It's certainly something we think about, right? You have young kids. I have a 21-year-old. We definitely think about it. Thank you so much and all the work that you've done. Really appreciate it. Gina McCarthy, I'm so glad I squeezed in on you.
We'd run out of time if I read all her titles and accolades.
It's really impressive, but it's why we wanted to talk to you. Gina
Former
McCarthy.
U.S. EPA Administrator under President Obama, the first White House National Climate Advisor appointed by President Biden. Once again, she's part of the coalition, co-chair of America's All-In Coalition, which is supported by Michael Bloomberg.
She knows something about the environment and climate change and all the work. We're just going to say that. If you missed any of it, check it out on our podcast feed. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
A better than good inflation report pushing bond yields down and lifting small caps up. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Is this a tech sell-off we've been waiting for?
I don't know. It's certainly a rotation, that's for sure.
No doubt. Let's take a look at it here because you're looking at an S&P is down by about 0.8%. We're off the lows, but just barely. The NASDAQ 100 down by about 2%. We haven't seen this kind of sell-off since October of last year. In fact, it's been 48 days since we've had all the Mag 7 down on one day, and that's exactly what we're seeing today. Now, where's the money going? Definitely going into the bond market, particularly in the front end. You have yields dropping there by about 11 basis points, 9 basis points on the long end, and it is going to the yen. Dollar yen down almost 2%. Romaine, the question has been, is the MOF in the market? Did they wind up selling the dollar aggressively once we had that CPI? But regardless, you're seeing that heavy dollar trade as we're pricing in more of those cuts.
Yeah, we talk about the seeds of the complexion of what we're seeing right now, and that was seeded earlier this morning on the back of that U.S. inflation report, a cooler than expected U.S. inflation report that injected another dose of confidence that the Fed will have no excuse not to cut rates. That confidence reflected in the double-digit basis point declines that we're seeing in short-term yields and the widest outperformance all year long for interest rate-sensitive stocks relative to big tech. However, whatever relief you see reflected in the Russell 2000 and in U.S. Treasuries, that sentiment of sort of we're finally out of the woods, that sentiment is far from universal. ConAgra Foods reporting earnings saying its cost of goods sold continuing to rise, and Pepsi saying snack sales volumes are lower as budget-conscious shoppers trade down. David Kelly and Mizuho's Steve Prosciutto, they weighed in earlier.
I don't see any reason why we should be headed for recession here, but we are seeing that slowdown in growth.
Is the economy going to stay a trend, or is it going beyond that? That's now the question they have to answer.
A delicate balance right now, and of course we saw that with the earnings out of ConAgra and Pepsi. Inflationary concerns also dragging down airline stocks. This after Delta said rising labor and maintenance costs are eating away at its profit margins, even, Alex Steele, with passenger traffic at record highs.
No, I'm not seeing the flight discounts, let's be honest.
I'm certainly not seeing them.
Right?
Yeah.
Okay, so let's go to the Fed funds rate. So this is a great chart that shows the rate expectations in the market for September, November, and December. So December is the yellow line, November the blue, and September is the white. What I want to point out here is the December line. So now we're looking at about 57 basis points of cuts so far for this year. So that implies 2 cuts now fully priced by the end of the year. When do we get them? We are almost fully priced now for 125 basis point cut for December, definitely in November. And you can see just how extreme the movement was after we got that lighter than expected CPI. And also so interesting, Romaine, in some ways that was priced into the equity market, in some ways, just not the bond market. But now we're seeing JP Morgan, for example, now seeing a cut in September instead of November.
Yeah, a lot of people really now doubling down on those bets on the back, of course, of encouraging CPI report. Data, of course, that did show inflation cooling broadly in June, driven by a long-awaited slowdown in housing costs. The numbers sending the strongest signal yet that the Fed might move to cut interest rates soon. Michael Gapin joining us, head of U.S. economics at Bank of America Securities here. It's a bet people in the markets are making, and we're hearing the same out of strategists. Michael, are you on board?
Not entirely. I mean, certainly we're completely on board with the idea that this is unambiguously good news for the Fed, and it's unambiguously good news for the outlook that the Fed will be cutting. So a deceleration in shelter, a deceleration in non-shelter services, and another month of decline in core goods. So it's all good across the board. As you said, a better than good report. And we would just say, though, the translation into PCE isn't all that favorable. And I'm not quite as negative on activity as I kind of hear Fed Powell was in front of the Senate. So we're still thinking the first cut comes in December, but certainly today's data brings September much closer to the baseline than it was before.
Are you seeing, though, a bit more equilibrium in the economy? And this is something that Powell was asked about and responded to over those 2 days of testimony. And, of course, he made it clear that he is starting to see a little bit more balance. And I'm wondering, does that work in favor of the Fed actually doing nothing for the foreseeable future?
Yeah, certainly we see more balance, and the evidence is suggesting the economy is cooling. I think the question is, does it meet kind of the Fed's nebulous bar of, quote, unexpected weakening in either the labor market or the economy? We don't think so. So it would still kind of foretell gradual rate cuts in front of us. But the economy is cooling, and the Fed's messaging on this front has changed. The dual mandate is back. It's no longer a singular focus on inflation, but it's also concerns about a cooling economy. So the Fed has kind of two paths to easing right now. One is inflation is in line with what they think. The other is the fact that we want to ease to preserve the expansion. So it's not just inflation anymore. It is about inflation and a cooling economy.
What do you expect from PPI tomorrow, Michael? And I say that because there was a great piece out on the Bloomberg that talked about how producer prices and inflation in China is starting to maybe pick back up a little bit. And we have seen PPI here start to rebound.
Yeah, and as I think you noted with some of the firm's earnings calls that you were referring to, that there's a tension here on the good side of the economy. So yes, the consumer goods data was soft on the month. That's mainly an auto story. But there's a risk around goods prices that shipping costs have moved higher again. Will that show up in higher producer prices? So I still think that that's a concern out there. But again, from the Fed's perspective, the idea here was that, hey, we need more evidence that services inflation is decelerating, because we know goods price deflation will end. So having shelter take a step down before we get indication that goods price payback is over, I think that's still very favorable on the expectation that the Fed will be cutting. So our view on PPI is very similar to the market on this one. We'll see how it comes in terms of PCE, but it seems like we're set up for a 0.2 on PCE inflation, at least at the core level for the month of June.
I know you're the eco guy, not the bond guy, but just for the 2-year down 11 basis points and the steeper curve, do you feel like this is the correct reaction? Are we overdoing it at all, doing the Fed's jobs for it before they have to?
No, I think it's the right response by the market. And I would just say, remember, if the economy is cooling and the evidence is pointing to a deceleration in employment, markets price distributions of outcomes. So the market will say, yeah, there's some risk. People like Mike are wrong, and it's not just a cooling economy. There's risk of a more abrupt slowing and greater recession risk. So the market, I think, will tend to price a little more cuts than the Fed expects to deliver. And so that rally in the front end, I think, is also giving you some of that flavor. I think it's completely reasonable given what we know.
And we sort of, as we wrap up this conversation, Michael, there's been a lot of discussion as we look a little bit further out into 2025. The idea here that what we've gotten so far in this disinflationary trend, whether that did come directly from monetary policy or whether it was more just some of those structural issues that sorted themselves out on their own, who knows? How does fiscal policy, if at all, complicate the situation, particularly with the huge supply of debt that's continuing to come out the pipe?
Yeah, here I would remind, or at least our view on this anyway, is that major changes to fiscal policy, may be dependent on sweep outcomes, but they're also dependent on the fact that the Tax Cut and Jobs Act doesn't expire until the end of 2025. So any budgetary negotiations and change in fiscal and tax policy may not happen until late 2025. So their effect on the economy and activity may not be until, say, 2026 and beyond. Doesn't mean markets won't react in advance to that, but what I'm suggesting here is I'm not convinced that fiscal policy changes will affect the near-term path for inflation. By the near-term path, I mean kind of inflation through the end of 2025, based on fiscal policy expectations alone.
All right, Michael, always great to catch up with you. We'll let you get back to work. Michael Gapin, head of U.S. Economics at Bank of America Securities, kicking off the show with a closer look at what's going on in CPI, the market reaction to that in just a minute, as well as a look at some of the big movers on the day, including Delta, having its worst day going all the way back to January of this year. Excess capacity, heavy discounting, and elevated labor costs dragging down that airline as well as its peers.
All right, plus you got Pfizer saying it is moving forward with a weight loss pill to compete with injectable drugs like Ozempic and Wegovy, but there are many questions surrounding that drug. We're going to get the latest.
I wonder if that's having an effect on Pepsi. They came out with earnings and it was weaker than expected, particularly on the revenue side. Volumes for snack food down, particularly for that Frito-Lay business. A discussion about everything ailing the consumer staples sector as well. That's coming up next, right here on The Close on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
All right, 50 minutes until the closing bell. It's Rotation Nation underway here. Sell tech, buy small caps. That is the trade of the day. NASDAQ 100 at one point having its worst day since October, where the Russell's up over 3%. Joining us now is Anastasia Amoroso, Chief Investment Strategist over at iCapital. Anastasia, thank you so much for joining.
Thank you. Good to see you.
Is this the tech sell-off we've been waiting for?
Yes, I think so. And it really shouldn't surprise people given how overextended tech has gotten. But obviously you needed a catalyst and we got a perfect one. And look, it makes sense that, tech has seen a lot of multiple expansion. It is fully accounted for, I think, the earnings potential, which is much more so greater than the S&P. But at the same time, now you have a perfect catalyst for small caps and utilities and other rate sensitive sectors like REITs, for example, which is the Fed rate cuts. And so I'm not at all surprised to see the rotation. And in fact, we've been seeing hedge funds that have been actively selling tech starting in June and continuing in July. And I think there's much more to that trade.
Why is now the time where small caps will be rallying for real and not just a fake out?
Well, growth has been okay and growth has been strong, but that was not enough to support small caps and the other parts of the economy. The reason being is there's a lot of leverage embedded, for example, in some of the small cap companies. There's a lot of leverage embedded in real estate, and what they really needed to perform are those rate cuts. And now with 90% probability of September, I think that's what makes it real.
Well, I'm interested in that correlation too, because there's a reason why you're seeing the Russell up 3%.
Yeah.
And I thought about that because everyone was saying, okay, the rate cuts were going to be the salve. Now, we're not necessarily getting them, or at least the Fed hasn't said we're going to get them.
Yeah.
But you have a bond market repricing for that right now, and presumably, at least for one corner of the equity market, also repricing to that.
I personally think the Fed is running out of excuses to not cut interest rates at this point, because not only do you have inflation that is clearly cooling, we got some great numbers within the print, whether it's on Supercore, whether it's just the monthly pace and the fact that it's annualizing at 1.1% over the last 3 months. So the Fed doesn't have the excuse that inflation is not coming down. It is. The Fed is also looking at the labor market, and there's clearly weakness that's emerging. And of course, Fed Chair Powell did admit this week that the labor market is in full balance. So what are we waiting for, especially when the economy is slowing down? So, to Alex's point again, that's what makes it real to me this time around. And when it comes to the market and kind of going back to the tech trade, the market prices this in advance. Part of the reason why we've rallied as much as we have this year is because we've been sniffing out those rate cuts. But what's interesting is the rotation that we're seeing is exactly what we have seen historically. Tech rallies into the first rate cut, then it consolidates in the 1 or 3 month period. But what tends to outperform are those interest rate sensitive sectors, and actually utilities ends up being the top sector in the 3 months following the first rate cut.
So if you haven't already sort of made either short-term tactical positioning now or even longer-term reallocations now, do you do that now, or do you wait till we get maybe a more clearer signal from the Fed that they're ready to start?
I think you go. I think you make some of those fine-tunings, along the periphery. Look, I'm not going to recommend to sell tech and never going to go back to it, because clearly tech is where the secular growth is. But you do want to probably trim, given how much tech has rallied. And we've seen some notable moves in those small caps and utilities and REITs. But if you zoom out and if you look at the longer-term chart, all of those sectors are coming from either a period of consolidation, underperformance, or even negative performance here today. So I think this uptick that we've seen is just a start of a move that could last 3 months or longer.
What about earnings? Earnings bar seems to be set pretty high, 8% earnings growth, particularly when it comes to large cap tech.
Yeah.
How would you be thinking about playing earnings season when we heard from Pepsi, right? Top line is struggling, margins are suffering.
Yeah. I mean, I think you want to be cautious and a little bit defensive going into the earnings season because, Alex, on average, you do typically get a 3 or 4% earnings downgrade going into the quarter. The bar gets reset lower, and so therefore it's easier to beat it. But that's not been the case this time around. We've seen a 0.5% downgrade to earnings, and so I think there's this sense of a lot of optimism and exuberance against the economy that it's actually slowed quite a bit. In the beginning of the second quarter, we were looking at 4% nowcast Atlanta GDP. Now we're looking at 1.5. And is that fully reflected in those earnings expectations? Probably not. So I do think we're likely to see a lower earnings surprise and therefore a market reaction that's more muted. So as you can tell, I have a more cautious tone on the markets overall. And it's interesting because we got to be careful, I guess, what we ask for. We've asked for the rotation, but it's here, it's now, it's playing out. Tech is selling off, but the market in aggregate is actually down.
Yeah, and it's be interesting to see whether this sticks once we get through earnings season and actually see the cards held not only by those large cap names, but the small cap names as well. Anastasia, great to have you here on the program, Chief Investment Strategist over at iCapital. And we talk about that rotation and sort of what keeps us sustained. I mean, I feel like we've been here a few times this year before where we kind of saw the great rotation and it lasted for like a week or less, and then people just flocked back. But maybe this time is different. Maybe we will finally get that equilibrium that Jay Powell talked about.
It's a fine line, right? Because if the economy slows too much that you really need those cuts, then that should be overall a negative thing. But if it slows just enough to get some cuts, that's helpful.
Yeah, this is
tight-roping.
Goldilocks, right?
Oh.
Are we not? Is that a banned word?
No, I don't think we can say that.
All right, coming up here on the program, a closer look at the big movers on the day. Airline stocks having one of their worst days of the year. This after Delta gave a weak outlook about summer travel. We're going to have more on why the airline says it's struggling to fill its airplanes. That's coming up next here on The Close on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
All right, time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start off with Costco. Bank of America saying that hike in the company's membership fee, music to their ears. The firm bumping its price target to $9.62 from $8.74. The big box retailer's first membership hike in 7 years. And analysts say customers are getting used to some of those higher prices. Nevertheless, the shares down significantly on the day by about 4%. Next up, Darden. Jefferies downgrading that stock to underperform. The analysts say the operator of Olive Garden could lose share if that squeeze on customer wallets continues to force the casual dining sector to rely more on promotions. The price target also lowered to 125 from 154. The shares, though, rising higher on the day. And finally, let's take a look at Spotify. A day after Redburn downgraded the stock to sell, Jefferies upgrading the stock to buy. The analyst at Jefferies says it's his top audio streaming pick, and he says he's increasingly confident in the company's ability to deliver sustainable revenue growth from, get this, price hikes. And he says there's room for those hikes at least every other year. The shares, though, down about 1.5% on the day. And those are some of our top calls. We want to turn now our attention to another stock that's been moving today, and that is Delta. Shares of airlines down, with Delta leading the charge here after it reported an outlook that disappointed the street. Sheila Kayalu joining us right now. She has a buy rating and a $56 price target on the stock. Sheila, we got to talk. I don't know what's happening, but I felt like a couple quarters ago, these airline CEOs were telling us everything was great. They were heading into the summer travel season, and they were going to be at full capacity. We see Delta's numbers, capacity slightly, the number of passengers slightly below capacity, and they're complaining about their own costs. What's going on?
So I think that tells us the story here, right? Delta's earnings were in line. Revenues were in line. Costs came in line. The stock is down 5%. The group is down as a whole. This group trades at 5 to 7 times earnings, 60% discount to the market. And what's happening is that Boeing's not delivering planes. On top of it, we have too much capacity somehow. Even though Boeing and Airbus are short of their delivery targets, the U.S. domestic market has too much capacity. Domestic pricing in the U.S. for Delta was up 4% for main cabin in Q1. It decelerated to 0 in Q2. And that consumer softness is what's causing the decline in the share price, I think. And in Q3, it gets even worse. So that's the bottom is Q3. Premium's holding on. Premium's up 10% in Q1, up 10% year over year in Q2.
It was interesting, though, that Ed Bastian talked about heavy discounting. Those are his words.
Yeah.
Just anecdotally, as someone who travels a lot, I've not seen that discounting, so I'm not exactly sure where that's happening. But is this something that investors should be paying more attention to?
It is happening in the U.S. domestic market.
Okay.
Not transatlantic, where pricing is still solid, Pacific as well.
Yeah.
But U.S. domestic, low-cost carriers, Southwest, Frontier, Spirit, are not in a good position. They're dumping excess capacity. So one of the things Frontier did in June was open up a route JFK to Atlanta. Now, you can't compete with Delta on that route unless you're pricing it for $50. So they're being bad. There's bad actors, and capacity is only up 4.5% year over year in the first half. That exit rate in September is up 3%. So Delta's basically telling us that capacity is going to get rationalized in the second half. I'm not sure I'm a buyer of it. Neither is the market, and that's why the stocks are trading down.
Also, you fly business, first class. That's the problem. This is the economy that's seeing the pressure. You just got to go down the cabin, and that's a whole different story.
Peek beyond the curtain, see how the other half lives.
That's how that is. What part of this is also just tough comps? Because last year and the year before were just so good with all the revenge travel.
A little bit tough comps. You're seeing that more in the Atlantic market, where it's just evening out. But in the U.S., I think it's really, it's hard to distinguish how much is the consumer softness versus how much is the bad actors in the market.
So if we're going to live in a world where airline travel will now match GDP rather than exceed it, how much do these stocks have to re-rate for that?
They're not going to re-rate because they're at the lows. I think they must.
There's no more re-rating.
They're at rock bottom levels when it comes to multiples for the airline group. So there's no re-rating, and that's what United and Delta have really argued for, is that they could sustain these earnings. I mean, they're still doing 13% margins even with a bad actor. So they're not bad companies, but they're not going to be able to re-rate higher or even trade at a 50%, 25% discount to the market because they're being seen as cyclical, and the rest of the industry isn't completely rational.
We'll talk about the cost issues. This also came up on the conference call. Of course, we know the labor costs were higher because of the new contract, but he also said maintenance costs were up as well, and he cited a couple other things that escape me right now. Is that going to be an issue for the other airlines when we get their reports?
Costs are okay, actually. Yeah. Surprisingly, maintenance costs were up 11%, and you're seeing the aftermarket stocks go down because maintenance costs in the second half for Delta are up only low single digits. But basically, everybody's trying to put capacity into the air to get as much profit as possible because pricing is down. So I think cost story is okay for the airlines for now. The bottom line is pricing. Pricing has been deflationary for the last 20, 30 years. And this is proving another year where you could get airfares cheaper than you did in 2019. And you can't say that for a lot of industries. And then what happens when Boeing comes back? Eventually, Boeing's going to get its act together and deliver planes to Southwest and United. Eventually. and then we have more capacity, and so then you could see others cut pricing even more.
Then we'll maybe see cheaper prices for domestic internet. Okay, all right, fair enough. Sheila, thanks a lot. We really appreciate it. Sheila Kayoglu, U.S. equity research analyst over at Jefferies. Because I'm with you, I do not see the lower fares at all when I'm booking.
Yeah, when I saw the heavy discounting comp, I was like, okay.
Let's get to it. All right.
But I mean, but I think Sheila made a good point too about the competition. I forgot about the Frontier thing, and I know I wouldn't be caught dead on Frontier or Spirit, but I know a lot of people who do fly those airlines, and there's a reason why they're booking tickets right now, because they are getting them for like $100 to go halfway across the country.
Right. So there is something for that. All right. Well, coming up, we're going to have another story here for the Pfizer's plan to introduce a weight loss pill.
A pill.
A pill. Once a day pill. That's better than a shot. Yeah. We're going to discuss that. The questions surrounding the drug, what it actually means, and how they wind up building it up. We're going to dissect that next on the close. You're still looking at a pretty heavy sell-off now in the tech market here. NASDAQ is down 1.7%. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Alex Steele. Looking at these markets, I mean, there are some heavy volume trades taking place, particularly within the airline stocks. I think American Airlines trading at $10.
Yeah, the drop in airline stocks is pretty severe, but I feel like this is kind of an own goal for them because all those CEOs, they were talking up how great this summer was going to be just a few months ago, and now we see the numbers, at least for the second quarter, and maybe they got a little ahead of their skis.
Maybe. Some of the stocks that are doing really well, that are having some heavy volume here, one of them is Pfizer, moving higher, up by over 1%. Drug company saying it's moving forward with a weight loss pill to compete with injectable drugs like Ozempic and Wegovy. Joining us now is Bloomberg healthcare reporter Damien Gard joining us. Hey, Damien, walk us through what this means. Meaningful progress moving forward. What does that mean for this kind of pill?
So basically what we learned is that Pfizer is going to press on with what would be, as you mentioned, a pill that would ideally replicate the effects that you see in injectable medicines that are already available. It's somewhat of an incremental story because basically there was concern that Pfizer would pull the plug on this project because earlier trials suggested it might have a side effect profile that would make it not really tenable for the market. What Pfizer said today is that they kind of went back to the lab, retooled the pill a little bit, and have come up with a version that they feel comfortable pressing forward into clinical trials. It's important to note it's still probably years away from FDA approval. They need to do now a mid-stage study to determine the right dose, and then that would lead to the final stage of development that would actually generate data needed to get it on the market.
Well, so just kind of explain that for viewers here, Damien, with regards to the difference between an oral medication and an injectable like you see with Wegovy, Ozempic, Mounjaro. There's a reason why there's concerns about side effects, because in theory, that pill, it would have to be a higher dose to get the similar effect of an injectable. Is that kind of how it works?
Essentially, yes. So it would be taken once a day, whereas the injectable medicines are weekly. And so the potential advantages there, I think there's the obvious one of many people would prefer to take a pill rather than inject themselves with an under-the-skin needle as the current product would require. But also, it's important to note that Wegovy, Ozempic, Mounjaro, these are drugs that are technically in shortage in the United States, at least. It's very difficult for these companies to make enough of it to supply the demand that exists. If Pfizer were to succeed in making a pill, that's something that conceivably it could crank out much more easily and more cheaply. Pfizer, a company that, in its heyday in the 1990s was making Viagra and Lipitor tablets by the millions. And so if they can succeed in this process, they could conceivably not only offer a comparable and cheaper product, but one that would be easier to supply around the world, where getting the auto-injector pens that have to be maintained in a refrigerator is much more difficult for Novo Nordisk and Eli Lilly.
So my question is, why is the stock carrying so much? Like, this isn't a cheap biotech stock, right?
Right.
Why does the market care so much about this, even though this could be years away?
Right. I mean, that in itself is kind of an indicator of how far Pfizer has fallen in the estimation of investors, really since COVID-19. This is a company that was making record revenue from its vaccine and pill for COVID just 2 years ago. But as demand for those products has really fallen off a cliff, so too has their stock price, and so too has, I think, Wall Street's approximation of their pipeline. There's not a lot in there that investors seem to be excited about. So this oral obesity treatment, even though it is only in the mid stages of development, has generated, I think, outsized scrutiny in the Pfizer story, just because people are looking for something to conceivably move the needle with respect to revenue in the years to come.
All right, Damien, great stuff here. Bloomberg Health reporter, a closer look here at Pfizer's efforts to create an oral version of some of these GLP-1 drugs, Alex. And of course, if we do sort of get that sort of mass production like he talks about and makes this available to everyone, then doesn't this start to become an issue for some of the food companies? I mean, everyone talks about it's not an issue now because there's some small percentage of folks on these drugs now, but if it's just a pill that anybody can get pretty easily.
I mean, if you ask Novo Nordisk CEO, even just like 6-10 months ago, he'd say, yeah, he's getting calls from food companies, really worried about it.
Yeah, and I've heard the same thing. In fact, I actually had a chance to spend a couple of days out at the headquarters of General Mills, where I asked them about the popularity of weight loss drugs and whether they were concerned about losing sales. I caught up with the CEO, Jeff Harmening, as well as the CFO, Kofi Bruce, on the new edition of Bloomberg's Chief Future Officer Show. Take a listen as to what they had to say about this.
General Mills can trace its history back to a single flour mill built in 1866. The company officially formed in 1928 through the combination of several competing mills. Since then, it's grown and thrived by anticipating challenges and quickly adapting.
We've been successful because we've changed, not because we've failed to change.
Right now, the entire food industry is dealing with a novel challenge: the rise of weight loss drugs like Wegovy and Zepbound.
I think the interest in weight loss drugs is here to stay. We survey consumers and see consistently that 30% of consumers are interested in weight loss drugs.
There's not an impact on our business today, positive or negative, frankly, with the weight loss drugs that have been launched. As you look over the next decade, most experts would say there'll actually be a minimal impact.
You're not making any major changes to the business specifically around the weight.
We have not made any major changes to the business at this point, nor does it warrant it.
In the center of disruption is always opportunity, right? So yes, it's a risk, but it's also an opportunity to differentiate. We don't necessarily get to pick the macro factors that impact our business. Our job is actually to figure out how to respond to them.
And you can catch the full episode of Bloomberg's Chief Future Officer across all of our platforms, including our YouTube channel that airs every Wednesday night right here on Bloomberg Television. A whole slate of these shows coming up, Alex. Of course, this is the kickoff for the new season. And we, as you can imagine, we talked a lot about weight loss drugs, GLP. And as you can imagine, they were a little defensive and kind of saying, look, this isn't a big issue. But they did acknowledge, as you said, they wouldn't tell me who, but they said, yes, they are in contact with these drug makers. They kind of want to know what's the uptake, how fast is it going to go, but they're confident that they can adapt to whatever changes this has on how we eat and what we buy.
Isn't the whole thing, though, too, is that you have to keep taking these drugs, that it doesn't actually change it 100% forever? So at some point, maybe you stop snacking for whatever, 2 years, but then you're going to go back at the end of the day? That's the question?
Yeah, and I asked them about that, right? This the idea that these are sort of forever drugs, and maybe that sort of ends up working to their advantage. You know, look, here's the company line. They're basically saying, look, we follow the trends, and if the trends end up where people are on these drugs, eating less, or eating differently, they'll adapt their product lineup to fit what that trend is. Now, whether you believe that or not remains to be seen.
Did you get free snacks?
We did the whole test kitchen thing. It was like, I mean, they were cooking and baking and doing everything for us. It was a lot. Yeah,
that's really fun.
I need some Wegovy after I got done with them.
Fair enough. And speaking of, we're going to talk about Pepsi next. So their shares are on the move. The company did report sales that slumped, signaling consumers are cutting back on snacks. Yet that stock is up on the day. We'll kind of get into that. It's today's stock of the hour. This is the close on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep
in World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
A Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
All right, it's time now for our stock of the hour. Keeping an eye on shares of Pepsi. The stock actually opened lower earlier this morning, now basically straddling the line between gains and losses. Some concerns here about weaker than expected revenue growth in the most recent quarter, as its snack food business was hurt by increasingly budget-focused shoppers. Joining us for more insight on the quarter is Barclays analyst Lauren Lieberman. She has an overweight and a 180 price target on the stock. And I don't know if you've been watching the stock moves, but it's kind of fitting. I mean, this was a stock that opened lower by about 3% and then kind of steadily climbed higher. It was in the green for a while, now unchanged. But it seems like this is that push and pull where some investors are looking at that top-line revenue number. They're really disappointed. But some folks are looking at that bottom line and the margin capabilities that this company has, and they're saying that there's still some daylight here for this stock to move higher. What side do you stand on?
Yeah, I think you've captured it perfectly. The one thing that you're missing is that expectations coming into today were the top line would be weaker. People track the Nielsen data or Circana data very, very closely, and it's been apparent that the Frito-Lay business has been under pressure. So where do I stand? I mean, I am of the view that betting against Pepsi over the long term, generally not a great idea when you think about the resiliency and the strength of this brand portfolio. And as you said, the ability to go after productivity. So as we get into the second half of the year, the plans that they are beginning to articulate and put into action to turn around the Frito business are significant. So I think we're going to see pretty quick change. There really seem to be lighting a fire under the frontline sales force. Their DSD capability is really distinct.
Yeah.
And to get into the market and drive that activity.
But what is it that they need to do here? And I guess it kind of, let me reverse engineer that question. It's kind of, what's the problem now that they need to solve, particularly when it comes to snacks? Is this a pricing issue, or is this more about better promotion and better visibility and storefronts? What do they need to do?
A little bit of both. But I mean, the core of it, and they said it themselves, it's an issue of value. You have a increasingly value-seeking consumer, and there are pockets of this portfolio where prices have just gotten too high. And they were very quick to point out that any adjustments they make will be surgical, will be tactical, all sorts of language like that. But where they have started to promote more heavily, as they put it, hot price points, they're seeing the volume start to move. But there's also elements of the portfolio, like the more premium end of the portfolio, where it's growing. You know, things like Sun Chips and popcorners and things that are a little bit more expensive and, quote, more permissible. Those have still been growing, and they're going to invest more in marketing and, like you said, availability and visibility.
What do you care more about, Lauren? Is it going to be top line and sales growth, organic sales growth, or is it going to be their margins?
I mean, well, it's both.
You gotta pick.
We analysts, we want it all. Yeah, but I do think what's going to drive the stock long term is top line. I mean, it's a consumer staples company, and what drives the long term premium valuation for companies like this is the brand equity value and the idea that over, we look out 20, 30 years from now, you expect these brands to sustain. Frito-Lay margins in particular are very, very strong, and I do think there's wiggle room in this model for them to make the choice to invest, to prioritize top line growth over margin expansion in that business in particular.
So we hear a lot about the value war in fast food, and it feels like we're going to be in a value war situation potentially with the snack guys. So based on that, what does that look like on a price level for like a Pepsi and a Coke, for example?
Right. Well, remember, Coke doesn't have snacks, so we're really talking about Pepsi and some of the food players that they compete with. But I don't think it's going to be, we're not talking war here. What we're talking about is there are certain segments of the portfolio, like plain unflavored potato chips or tortilla chips, where you see that more decidedly value-seeking behavior. There are areas of the portfolio where Pepsi leaned too heavily on innovation that just wasn't resonating with consumers, and they're going to go back to the core. So like flanker products on Doritos rather than like the straight down the middle Doritos, and Cool Ranch that people love. So focusing on assortment and, as they call it in the industry, price pack architecture, but making sure that there are packages on the shelf that allow consumers to buy the products at the price point that they need to. And you can do that through volume. You can do that through package size, right? A 10-pack versus a 12-pack on the shelf, things like that that make it fit into the budget that a consumer has to spend on a daily or weekly basis.
Hey, Lauren, we really appreciate it. Thank you so much, Lauren Lieberman, Barclays analyst, joining us on Pepsi. Man, I haven't had Cool Ranch Doritos since like the 90s.
Yeah, I'm actually going right now through the Doritos website. I'm astonished at how many flavors of Doritos there are out there.
Sticks.
They got flaming hot queso, hot honey mustard, smoky chili this, and tangy barbecue that, chili limon.
My tummy already hurts.
Your face says
so
no.
My face says no.
Me no
My
want.
stomach already hurts.
Yeah.
Me no want that. All right, we're going to cut you down to the closing bells. We're about 15 minutes away. Rich Ross, head of technical analysis of Evercore ISI, will be joining us. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
part of the reason why we've rallied as much as we have this year is because we've been sniffing out those rate cuts. But what's interesting is the rotation that we're seeing is exactly what we have seen historically. Tech rallies into the first rate cut, then it consolidates in the 1 or 3 month period. But what tends to outperform are those interest rate sensitive sectors, and actually utilities ends up being the top sector in the 3 month following the first rate cut.
Anastasia Amorosa, Chief Investment Strategist over at iCapital, a tale of two cities in the market right now with the Russell 2000 near the highs of the day, the S&P and NASDAQ near the lows. Romaine Bostic alongside Alex Seal. Scarlett Fu joining us a little bit earlier to help carry us to the close. And Scarlett, this is really about that big rotation out of tech and I guess into some of those forgotten names.
Yeah, as much as we're looking at the S&P 500 and NASDAQ decline, you look at the breakdown within the S&P 500, 393 names rising and 109 declining. Of course, it's all the big tech names, so that's what gets everyone's attention. The question is whether this is sustainable past this one day.
I was talking to someone on the street who was saying that it's been 48 days since all Mag 7 stocks sold off at once, and we haven't seen that in years and years and years, and now we're definitely seeing that pretty much on heavy volume and flow also. Absolutely,
yeah, the volume picking up as well. And of course, as we get into the earnings season, and Alex, we talk about the individual moves on the day down right now in the S&P 0.8%.
Yep, you're looking at that, looking at NASDAQ. Tesla, really one of the losers there, down by over 8%. It's hard to know, though, was it triggered? Yes, okay, the robotaxi thing, but were you just waiting for a sell-off, or was there some real fundamental news, for example?
Who knows? I mean, it wasn't it up for like 12 straight days?
That's what I'm saying. Like, it's just like, oh, okay, let's just get rid of it for a second.
Yeah, and maybe it's getting caught up in the downdraft. I don't know. Did you actually think that robotaxi was coming next month?
No.
Okay, I didn't.
That's what I'm saying. But you do look at the chart, and you can see a downdraft right when that headline did break.
Yeah, and enough people believe that it might continue to be a theme that they're like, we'll buy in on this.
Yeah, absolutely. Here, interesting market moves today. We should point out the VIX slightly elevated. Seeing a big sell-off in the dollar and a big rebound in gold, and of course a big drop in Treasury yields across the board. Let's get a more technical look at what's going on in the market with Rich Ross, head of technical analysis over at Evercore ISI. No relation to Rick. Let's talk about some of these technical moves, because when we talk about the sell-off that we're seeing today, particularly in tech, I'm wondering if that is really a lot of folks kind of looking at some of those technical measures, seeing that they're a little stretched, and now with the aid of lower rates, at least in the Treasury market, lower rates right now, that was kind of the signal to say, okay, now we find those entry points in the beaten down small caps.
Yeah, I think that's fair. What we've seen is a market that's been driven by momentum. And as we know, momentum cuts both ways. It's driving the winners higher and the laggards lower. And today that band just decides to pull back, obviously. A little better inflation data, a little relief on the interest rate front, more than a little bit of relief. That dollar weakens, so you bring some of those economically sensitive laggards, which have been stretched to almost historic extremes in terms of their relative underperformance. You bring those back into play. So I think to answer your question, I think one day does not a regime change make. You don't want to get too far away from the big tech, the quality, the growth, the momentum trade. But by the same token, you do want to get more excited about those stocks and those areas of the market that will benefit from lower inflation, lower interest rates, and easier policy, all three of which I think we've gotten today.
That feels like a buy small caps situation. Is that?
It is a buy small caps, but importantly, it doesn't mean get out of your high quality large caps.
It doesn't mean sell tech, buy small caps.
It does not mean that, and that's what a bull market does. It is the rising tide that proverbially lifts most, if not all boats. And again, this is a uniquely strong bull market. I mean, you talked about it today, 393 advancers. You know, as much as we decry the narrow breadth, be careful what you wish for. Today, breadth expands, it explodes into the stocks that you wanted to work, and what happened? The S&P goes down because the 393 don't make up for the 7 that aren't working today.
Yeah, the 7 that aren't working today is dragging everything down, and you look at the S&P 500's relative strength index, and as a technician, I know that you pay attention to this. Prior to today, it was at 81, which is well above the 70 level that considers it overbought. So now, after today, it's come back down, but how much of this is a knee-jerk reaction versus something that's a little bit more sustained?
I think for now the punishment fits the crime. When you talk about the strength in those stocks, the triple Qs alone up 22+% coming into the day. The Russell 2000, by contrast, 2 days ago was down on a year-to-date basis. So consider that in a runaway bull market with the triple Qs up 22%, the S&P up 17+%, for the Russell to be down year-to-date. So I think those overbought conditions finally come home to roost. years. You know, stocks are a function of both price and momentum. We haven't seen any evidence of exhaustion in price, but you've seen that backdrop, those sort of extreme overbought conditions in certain cases. A stock like Tesla making it to 87 on the RSI. Keep in mind, Tesla up 50% over in just 1 month alone. So a little bit of a pullback, a little bit of that proverbial pause that refreshes, overdue. But again, this move is not over per se to the upside.
I wonder if we kind of look to some of the broader sectors here, particularly as we head into earnings season and we get into a lot of big names, primarily next week. I'm going to get the banks, but you know, who wants to talk about banks? But when you get into some of the techer and the sexier names, the Netflixes of the world, like what are the ones heading into this earnings season that you do think has probably one of the better technical setups?
Yeah, look, I think it's one of the things that keeps me so bullish of markets more broadly and those big tech stocks, given their heft in the averages. They're all in an outstanding technical position. Take a stock like Amazon, just to pick a name. Why don't we? It just broke out from a 3-year base to an all-time high. It's a stock that if you go back to the highs in 21, it's up about 8-9%. So for those that think that every stock is stretched like it's 99, it's just factually not correct. Amazon is a stock that, again, it's up mid to high single digits over the last 3 years. It's just breaking out now, both relatively and absolutely. So that is a stock that is absolutely for me. Meta would be another great example of a stock that had been moving sideways for the better part of the last 5 to 6 months after surging. The biggest one-day gain in market cap in January. We've just spent the last 5 months consolidating that move, and now it breaks out again to a new high. Obviously not today, but those are two great examples of stocks that are not overextended, they're not uniquely overbought, and those are the names that I would like to buy, amongst others, as you go into earnings season.
What about Apple? So has had like a huge move, right? But is it the kind of stock you want to buy? Like, it hasn't had a sideways move like Meta.
No, but it actually has not of late, because we consider the overt strength. Keep in mind, less than a month ago, Apple was down on a year-to-date basis, and it was sort of the, I'm not sure what the proper phrase was, so let's avoid the phrase for what Apple was, but the point is it's back in the conversation now. It's a stock that had moved sideways for the better part of the last 12 months in a runaway bull market. So to me, I guess the key point here is that when things break out from consolidation, from well-defined trading ranges, you want to buy the breakout. And Apple is exactly that type of stock. And if I could just make one last point on positioning and sentiment, you know, these stocks are so big. We're talking 7% of the index for whether it's Microsoft, Apple, and NVIDIA, and very few fund managers that run balanced funds can overweight these names. If you overweighted them, you'd have 30% of your stocks in your portfolio in 3 stocks. And you know, went to NYU, that's not exactly a balanced portfolio per se. So I guess my point is that these stocks are perpetually under-owned to a degree.
Let's talk about home builders. They're up about 7.3% today, of course, benefiting from the lower rate thesis out there. Biggest gain since November of 2022. What do you see in terms of the technicals here? Because before today's move, you know, the chart kind of goes like this, and then you go, you know, it's a parabolic move.
Yeah, and again, I think that's one of those great setups out there where you don't need to have regime change out of these large cap winners out of the Mag 7 to go and buy home builders. Home builders, thank you very much, can stand on their own merits. And by that, they've had a pretty weak run, both absolutely and relatively. But importantly, you didn't break any of those major charts. You think about the big names, whether it's Lennar or a D.R. Horton. Yes, they've gone through a tough stretch, but keep in mind, these were some of the great outperformers off the bear market lows. So to me, yes, it's a big move, surging off the 200-day moving average, whether it's the ITB, the XHB, the Lennars of the world. But again, this is the beginning of a new move. Maybe it's just a counter-trend move this summer, but these are big bull trends that are intact. I would buy today's strength.
All right, Rich, great stuff. Rich Ross, head of technical analysis over at Evercore ISI, helping us count you down to those closing bells. We're just about 1 minute away here, and the trade is looking really interesting here, Alex. We talk about that differential between the broader market, and let's just say big tech, and the small caps, the smaller market here. Biggest outperformance we've seen, Russell 2000 versus the NASDAQ versus the S&P. Since March of 2020.
I think it'll be really telling how we open tomorrow.
Yeah.
Like, is it going to be, okay, we got it, we got that 2%, let's go ahead and buy the dip, or is it going to be, let's see some follow-through selling and really sort of flush that out a little bit?
I mean, I know you poo-poo the banks, but they will help determine what happens tomorrow, especially given how the Russell is so heavily weighted towards the financials.
Correction, the banks poo-poo themselves, Scarlett.
That was really funny.
Are we allowed to say that?
Yeah, you just did. Own it. You're good.
I am curious, though, I mean, when we do hear from the bank, because obviously a lot of the trade today is kind of macro-driven. Obviously, the CPI report feeding into the Fed. Does that change when we hear from the banks? Because we know they give a pretty good macro picture, at least the big ones, too.
Yeah, absolutely. These are all big questions. Jamie Dimon, how does he describe the state of the economy and the state of the consumer, right?
All right, we get the closing bells here in New York. A really interesting day here. We should point out, and I think Scarlett flagged this earlier, yesterday we had about 80% of the S&P stocks were higher on the day, and that led to a 1% gain and another record high. Today, 80% of the stocks in the S&P are higher, yet we have a 1% drop in the index on the day, 0.9% to be precise, largely because of the drag from some of those big cap tech stocks, down 49 points. The NASDAQ composite down more than 364 points, or about 2%. The two bright spots, though, you're going to find that in that sort of more cyclical and economically sensitive space. Dow Jones Industrial Average basically up about 0.1%, but a 3.5% gain on the Russell 2000, 2.5% on the S&P 400 mid caps, and Dow Transports, guys, up about 2% as well.
Advancers overwhelmed the number of decliners, both for the S&P 500 and the NASDAQ composite. The NASDAQ composite down almost 2% on the day, and of course we're waiting for the numbers to settle. But the number of advancers, 2,455. The number of decliners, 721.
Wow.
Pretty telling. All right, there is the IMAP for the S&P 500. It's a pretty mixed picture overall, and that's because the smallest sectors are seeing the biggest gains. Real estate investment trusts, utilities, materials, they're doing the best, all gaining at least 1.4%. On the downside, all the big cap tech names, right? Infotech, communication services, consumer discretionary, they're all the big drags, and you can see those group each down 1.5%.
Well, no doubt you have utilities and real estate stocks doing well, in part because yields are much lower, particularly on the front end. So 2-year yields down by 11 basis points, and then you go to the 10-year down by about 8 basis points. So you are seeing sort of that bull steepening in the curve, more buying on the front end and the back end, and that curve gets steeper. We've been waiting for that trade to really wind up playing out. Bill Gross weighing in on X, saying that the 2-10 yield spread's now at negative 31 basis points. It's headed to negative 10 basis points as the Fed does cut rates. It says the curve is disinverting. You own the 2s, not the 10s, not the 30s.
All right, we go back to what the equity happened in the equity market today. Some big movers out there. Home Depot, Berkshire, Uber, some of the biggest gainers on the day. Bailey Lipschultz joining us right now to walk us through those gainers. Jess Menton also joining us on set to walk us through the decliners. But of course, we start with the winners.
Start with the green. Yeah. That's where it's at. And as you had mentioned, small caps outperforming. Really strong day with real estate. So real estate stocks having their best day in over a year. After that CPI print, want to call out Builders First Source. They're operating in that space, but pretty much any company exposed to real estate, whether it's home improvement, whether it's making homes, whether it's selling homes, outperforming this morning. Maybe those interest rate cuts are going to play out. People can renovate their houses, maybe even buy a new house.
Buy a house, maybe? So we don't have to live in a cardboard box alongside Central Park?
Sure. I mean, that's what you're saving for. I mean, you know, it's
I mean, that's how you save money.
It's tough out there. Well, it's tough out there for Tesla, which I will leave to Jess, but I will call out that two stocks that outperformed, Uber and Lyft, this coming because of potential delay for robo-taxis, maybe actually will benefit these companies. They are beaten down, though, when you look at a Lyft chart. Actually, please don't if you're an investor, just because really has not come anywhere near some of those peaks that they
I'm kind of for the robo-taxis. I mean, I feel like the last few Uber drivers I had, you know, I think they're like Mario Andretti or something. It's like,
this will be an improvement.
Yeah, I mean, it can't be any worse. I'm usually just in the back seat with my head down, trying to not have to look out the window.
I like my guys. I've had no problems. Maybe it's a Brooklyn thing. What else are you looking at? So you were talking about the home builders, but also a Builders First Source?
Yeah, Builders First Source.
I don't know that stock.
So they make and sell different things like vinyl siding and helping with windows. So it's kind of goes into the whole, if you're a homeowner and want to make home improvements, you're buying products that they're making, or also if you're building a house, they're going to have some pretty strong B2B sales in terms of that. And we also really are just kind of calling that out because it's the top performer in the S&P 500.
The home universe.
Yeah. And one company, though, that rallied today, MicroStrategy, announcing 10-for-1 stock split. And it seems like these are never going to end. So stock ended up...
Now, how does that work? Does that mean the valuation goes up by 10?
Yeah, it depends who you talk to. If you have laser eyes on X, and you probably find some weird...
I was a little confused as to why it would rally on the back of that. But, I guess the psychology of investors,
People like smaller stock prices. We saw NVIDIA roll it out. This will take place in August. Stock closed at $13.58, so 10-for-1 cuts that down to $135, but did rally 4%. Bitcoin had been outperforming the broader market in a down day, so I guess maybe there's something bullish there, but I don't know how if you cut more slices into a pizza, it makes the pie bigger. But
it depends on your stomach. Okay, let's go to Jess. You were looking at the decliners, of which there are also many to choose from. What do you got?
Right. Well, I'm going to start with Tesla because Bailey did bring up what was happening with Uber and Lyft rallying on the back of the news that Tesla did delay those plans for its robo-taxi from August to October. So when you look at that stock, Tesla's down 8% today, worst day since January 25th. It actually had been on quite a tear because it was actually the worst point decline decliner in the S&P 500 in the first half of the year, but it had rallied about 44% over an 11-session span. Of course, that did end today, and it lost about roughly $60 billion in market value. So that's the flip side of, even though you're seeing Uber and Lyft, obviously winning on this type of trade right now, but unfortunately Tesla's on the other side of that, because obviously it's going to be a competitor, and if it's going to delay those plans for its taxi type of...
Now, just to be clear, so they said they're delaying it to August,
yes.
But this is just kind of announcement.
To October.
I mean, to October, right. But this is just the announcement.
Right.
Like, they're not putting a robo-taxi on the street in October.
No.
So I'm confused.
There's still more news that we need to have.
Yeah, so if the announcement's delayed by 2-3 months or whatever, I mean, why is the sell-off?
Because if you are a Tesla shareholder, you buy or sell based on what Elon Musk says.
But also, isn't this just a point of
Seems like a sound plan.
If your stock has run a lot, it's not going to take a lot for it to sell off. Like,
Right.
is that also maybe a takeaway that we can get from that, which is kind of also maybe a setup for the airline stock? So that had a fundamental reason for selling off.
Right. I know you were talking about when it comes to revenge travel and if that was some of the reasons, because Delta is the first airline, of course, to report this earnings season. We'll have United and others coming in the next couple of weeks. But when you're looking at this, it was more, you're still seeing strong travel demand there. You're still seeing business travel also strong, but it also has to do with the capacity issues if you're looking at the year-over-year periods. And so that's something that their CEO talked a lot about and how they're trying to kind of mitigate that. But I feel like when I'm going and I'm still paying for flights, they're still pretty pricey, and I still find them to be pretty expensive when I'm traveling.
Yeah, what was Ed Bastian talking about? He's talking about heavy discounting. I was like, dude, heavy? Like, I think his version of heavy is different than ours.
We're just going to the wrong place. We're in the wrong class of plane, and we're going to the wrong places.
I am curious, though, but in all seriousness, though, he did talk a lot about costs.
That's right.
Being higher. And we spoke to Sheila Kahyaoglu earlier, and she kind of dismissed that, saying that they should be able to get that under control and deal with margins. But was that part of the reaction?
Yes, it was. And if you look at also when it comes to other airlines beyond that, if you're looking at the passenger airlines in the S&P 500, down about 3% today. It's the worst day since actually the beginning of April. So you are seeing that more broadly, not surprisingly, weigh on those other airlines as well.
We talked about discounts. My favorite place to go to is Costco. I mean, to look for those discounts, but I end up spending a lot more because the price point of everything is at least $10.
Wait, don't you have those giant things of lotion?
Yes, the face, yes.
Like oil of. It's very horrifying when I found this out. Go ahead, sorry.
Horrifying. So they announced that they're increasing their membership fees, which is something analysts had anticipated, and it was seen as good news yesterday when the news came out.
Yeah. Well, D.A. Davidson actually came out today and was talking about, well, why are you seeing it sell off after we had an initial reaction that was higher on the news this morning, especially in pre-market trading, and they were saying usually when it comes to these types of announcements, you do see the stock historically end up declining on that. But it's been a while. It's been about 7 years since the last time.
Kind of to sell the news, because I feel like people have been talking about this for a couple years, like saying they're going to do this, they're going to do this, and then when they got the new CEO, everyone said it's coming, right?
It's coming, right?
Yeah. Well, they held off on it for a little bit because of inflation concerns, but you go from those gigantic shampoo pumps to the little ones that they offer at hotels. They are not doing that anymore in New York starting in January. This is terrible news for anyone who gets their supply of little shampoos from hotels.
Speaking for a friend, right?
Speaking for a friend, of course.
Assuming that one might go and steal all the tiny shampoo bottles from hotels, this is a big bummer.
It's like an episode of Friends where Ross does that. He loads up on everything.
And then she has like the big... Anyway, but it is a real thing, and it is very upsetting.
Exposing us all,
But I've always seen the big pumps in hotel rooms now. Like in the shower, like the big pumps with the shampoo.
Yes.
I don't see the little bottles anymore.
Well, I mean, up until now, New York was doing it, and I think a lot of other places were transitioning to the big pumps, but the concern here in New York is that people might not want to use, first of all, it's difficult to clean, but also people might not want to go use the big pump because other people have been touching them. So now they're gonna change it into like a little ketchup packet.
For a friend.
Look on roommate's faces.
Other people touched it, but you're in a shower, so the whole point is to get clean. So it doesn't matter.
Also, like, you're also in a room that someone just slept in. But
roommate's over it. Look at that reaction.
Where's the line?
All right, guys, thank you so much for helping us walk through the gainers and losers today. Really interesting day in the equity market, given the major indexes levels and the actual gainers that we did highlight here. Our thanks to Bloomberg's Bailey Lipschultz and Jess Menton. And that does it for, no, we don't have a simulcast today, right? But that does it for us for now.
All right. Coming up here, we're going to talk a little bit more about President Biden, set to have a press conference tonight, a solo press conference. And of course, everyone's not so much interested in policy, but how he performs. A discussion about that and what to expect after the break. This is The Close on Bloomberg.
news in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day, particularly when you put it up against what we saw yesterday. You pointed this out earlier here. We had a broad-based rally yesterday with about 80% of the S&P stocks higher. Believe it or not, we kind of had a broad-based rally today. It just didn't actually translate into actually broad-based gains. About 80% of the S&P stocks were higher on the day, but the big drag of big tech, that was not enough for the aggregate market to do anything. You see that really reflected in the NASDAQ 100, the big laggard on the day, down about 2.2%. But look at the differential there with the Russell 2000, a 3.5% gain in the Russell, the best day of the year for that index. But that differential here, 5 percentage points, we haven't seen that type of differential between the small caps and the big caps going back to the pandemic, the start of the pandemic, March of 2020. A lot of that had to do with the big drop that we saw in yields, down about 11 basis points on the short and a sell-off in the dollar as well, Scarlett. And you wonder if this has changed the complexion of what people are going to buy and what they're going to sell.
Yeah, everyone was waiting for so long for the broadening out of the equity market strength, and we finally get some, but the indexes show deficits. Now, one big reason why is because of what happened with the Magnificent Seven. Let's start with Tesla, which was the worst performer of those Mag 7 names, losing more than 8% on the day. It was the most active company stock by value, and it had gained earlier, but Bloomberg reported that Tesla is now delaying its planned robo-taxi to October by about 2 months. So the initial plan was August 8th. And of course, this is the unveiling of the robo-taxi. It doesn't actually mean that it's going to be on the roads. Optimism about the robo-taxi and, of course, just things that Elon Musk was kind of hyping had led to an 11-day rally for Tesla, which added about $257 billion to its market cap. Now, Romaine mentioned small caps. Let's take a look at a small company here. Lantheus Holdings, LNTH, up by almost 17%. This is a fresh record high, and it builds on yesterday's 37% surge that a Medicare payment proposal is seen as a positive for this company, which makes diagnostic medical imaging products. But when you put it all together, our top story this hour is how the latest inflation reading has got to be welcome news for private equity. Because the industry is heavily dependent on debt, the current higher for longer rate environment has been painful, with buyout firms using creative financing to defer interest payments, unable to exit their investments profitably. Even with assets growing, we are seeing lower returns for funds and disgruntled pensions, insurers, and other investors that put their money into PE funds. We're a long way away from the cheap money era, but if the Fed starts cutting rates meaningfully, then perhaps it'll be easier for PE to exit their investments, raise money to start the cycle all over again. Romaine?
The macro story is certainly dominating for the day, but quite frankly, it's been dominating all year long. A lot of discussion here about the outperformance of the U.S. economy. That's been front and center, but investors divided on how much further that narrative has to run.
And I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were.
The pendulum has swung back. We're not focused on China. We're not focused on emerging markets. U.S. equities are outperforming, and even if it's just one sector or a couple companies, it matters.
Some of the great voices we've had on this program over the last few days and weeks. Another one joins us right now, Whitney Baker. She's the founder and CIO of Total Macro, a boutique global macro investment firm, formerly ran the EM shop over at Bridgewater. Thank you for being here, Whitney. There's been a lot of talk about how there really is no other place for investors to go other than the U.S. Do you buy that?
That's been a story for 15 years and obviously post-COVID as well. I think it sort of behooves us to zoom out a little bit at what's driven that. And really there's been two things, both for the 15-year view, this whole cycle, and also post-COVID. Those two things were more money printing in the US than elsewhere, and basically better economic growth and better earnings. And some of that earnings was obviously the secular nature, secular growth over cyclical growth that tech benefits from in this cycle. But some of it is also just the better job basically fixing the banks and kind of getting the economy off the ground when the other global economies couldn't. And so the consequence of that is a lot of money printing has driven asset prices up. Nominal GDP has kind of stagnated down here, but been better in the US than elsewhere. And you've got this huge financialization, essentially asset inflation instead of broad nominal growth, because the money is feeding into that channel, whereas credit has been basically deleveraging this whole time. And that just went into turbo drive post-COVID. And both those things are ending, basically.
Why are they ending?
Okay, so you have to zoom out a little bit. Obviously, we know that the U.S., if you think about the big picture, it's the world's biggest debtor now. That debtor position, what I mean is they run perpetual current account deficits vis-a-vis the rest of the world, and also on the fiscal side is a big contributing factor to that. What that's meant is that, it's not a news story that Asia has essentially financed the U.S. all of this time. But just for context, the U.S. debt position versus the rest of the world was about 10% deficit or total debt stock, net debt stock in 2007. Over the course of this cycle of all of this Asian buying of U.S. assets, really sucking, essentially U.S. has been like a magnet sucking in every dollar of cross-border capital this cycle. And so now the U.S. owes the rest of the world about 70% of GDP, which is, well above what most emerging markets reach, and that's sort of our area of expertise. At the top of their balance of payments upswings. So the reason it's ending is it's not the reserve currency argument. The focus is entirely in the wrong place. There hasn't been a reserve currency bid for U.S. assets since 2015. What's happened for the last 10 years is that Japanese banks and Asian real money, including Taiwanese life insurers, Korean pensions, Canadian real money, those investors have channeled all of their assets into the U.S. and essentially financed this cycle because it was the best place to be in that environment. And so they're now essentially balance sheet constrained to keep doing that.
So your thesis that American exceptionalism is ending really goes to this idea that there's a big regime change. Has it ended already, or it's going to end? I want to get an understanding of how long this transition period is.
I think that we're in recession already. I think that in the U.S., I think that it's a shallow recession because it's basically a little bit of consumer services, business services coming down and offsetting this structural investment drive and things that we've all talked about, climate change, militarization, re-onshoring, all that stuff. Meanwhile, the rest of the world just had a big recession because when rate hikes happened post-COVID, they immediately flowed through to the rest of the world because there's floating rate debt there, and they just didn't flow through in the U.S. until very recently. So the U.S. is basically going into a shallow recession. So the relative growth supremacy is going elsewhere. The nature of that growth will be much more cyclical than structural. And then obviously, like in terms of preferring tech over other sectors and drivers. And then really the main issue is that the money printing is now ending for a variety of different technical reasons. For the next 6 months or so, there's really no money printing. And that has been the thing in the last year through April that's really driven the U.S. stock gains.
I am curious that when you look at economic conditions in Asia, particularly given some of the policy decisions that they've made over there here, are we looking at a potential upswing? Because I think a lot of people were certainly banking on that with China and even some of the other countries in North Asia, this idea that there was going to be this upswing, this valuation. That didn't materialize, at least not to the strength that some people thought earlier this year. Is that kind of a pipe dream? Do you find any sort of fundamentals to support that?
Yeah, so no, I don't think that's going to happen. North Asia and the U.S. have been the two engines of economic strength this cycle. The only places in the world that have actually leveraged up for the last 15 years, Europe and the rest of the emerging world, they've all been trying to get their balance sheets in shape. And so the issue you have is because of all of this money printing in Asia, low rates, a lot of that channeled into U.S. assets, sure. But on the other hand, a lot of it got channeled into domestic debt and property bubbles. And that's what you're seeing really across the board, but particularly with China. They're prioritizing their currencies over easing to deal with that. And so you just have this balance sheet challenge.
Just real quickly, we're almost out of time, but is there any pockets of EM right now that you do find attractive relative to the U.S.?
Yeah, absolutely. I mean, EM is the opposite side of this story. The way that BRICS was the sort of leadership group of the last bubble, FANG has been the leadership group of this bubble. And all of this basically argues for a lot of dollar, sort of a dollar unwind, right? The currency is very strong, and all of these flows have come in and supported U.S. assets. These financials in Asia are going to have problems holding those assets because of a combination of things, but mostly because they're also doing their own QT. So there's money contraction basically across the board, and there's carry unwind now in the U.S. because U.S. dollar has become a carry trade. So that unwinds with